We have an economy that's going to continue to grow, but the largest gains may be behind us.
Almost everything has told us here that we're in a regime shift. We're going to now see growth decelerate and inflation decelerate.
We are going to see a deceleration in growth, that's for sure. But I think the U.S. consumer will stay quite resilient.
The recent move is overdone. You're going to have a push higher for the remainder of the year.
You're not going to see deceleration until sometime into next year. There is still plenty of room for the economy to run.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Let's get the weekend started from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene. I'm Jonathan Ferro. Lisa back with us on Monday. Together again this morning with Taylor Riggs. Tom Keene, you got something to say? I could just feel it at the end of your tongue.
Yeah,
what is it?
Well, rumors has it Lisa will be back here. The rest of us have been slaving away. She's been off on a sabbatical of sorts, and we look forward to seeing her back. And Taylor, I know, is going to get to earnings here that she observed yesterday afternoon as well. John, we got to go to the equity markets. The bears are in retreat.
Up 20 on the S&P 500, advancing 0.5%. This market looks good. Joyce Chang of JP Morgan joining the team about an hour ago, reiterating this 4,600 view that's come out of JP Morgan in the last couple of weeks. And the bulls are still bullish, Tom. Surprise, surprise.
Well, the bulls are still bullish, but they've got earnings to back them up. There are any number of earnings. I'll let Taylor, she's better at it than I am, but just Danaher in the COVID business just blew it out. I mean, there's no other way to put it. Citigroup, I know, went up to a 345 price target. And you wonder, John, how many Danahers are there going to be?
I think Danaher record high, the Nasdaq 100 record high. Twitter Snap, let's go there right now. Taylor Riggs, after the close yesterday, they just blew it away. And Facebook and Google are joining the party this morning.
Yeah, unbelievable. It was Mandeep Singh of BI saying that if you're an advertiser, you want to be on these platforms, namely Snap. Jeffries, of course, saying that if it's a choice between Snap or Twitter, they want to be in Snap as well. It's pretty incredible, the type of growth that you've seen. Higher daily active users than Twitter, John. Almost double, I think, the market value now. I thought a 10% move was incredible. 16% move on Snap. Every premium content wants to be there. It's Rich Greenfield over of Lightshed. He raises the price target to an 84.
Wow. Facebook up 2.85%. This just raising the bar, Taylor, for big tech earnings next week.
And everyone had given them sort of a lot of frustration of NASDAQ 100s at a record high, as you mentioned, John. How much of this is just a defensive move? But these are the companies, as Joyce Chang alluded to, they're turning out free cash flow. They're showing up. They're outperforming.
The numbers look good on Wall Street and beyond. And I have to say, this has been the most peculiar week. This is the price action cross-asset right now. Equity futures pushing higher once again. We've seen a string of gains through the week so far. We're set to add to them. The S&P 500 up another 0.5%, advancing 20 points. But, Tom, what gets my attention is where the 10-year yield is right now.
Yes.
We closed last Friday at 129.03. Here we are at 129.47.
Nothing's happened.
On a week where we saw 112.60 on 10s. On what, Tom?
The gyrations are there, John. I like what you just did on Twitter, the Reuters article, where there's some real dissent at the ECB. You carry that over to next week at the Fed. Is the Fed all on the same page? I'm not so sure.
Do you think someone walks out? Do you want to go to that article right
now?
No, I don't think
they're going to walk out.
Let me just share the quote, Tom, so people understand what we're talking about. A third policymaker who also voiced significant objections had to leave the meeting early and was not present at the final tally, according to some of the sources that Reuters were talking to after that meeting yesterday. I don't anticipate that's what happens with the Fed next week, Tom.
No, I don't think so. They may not even have a dissent, but I just think there's into the weekend where we're all reading and trying to recalibrate for Q3 and even re-guesstimate for Q4, John. I think it's just a weekend to really think about what your conviction is in your belief. And the conviction I see on the screen is the bears are in retreat.
They are. Equities up by around about 20 points on the S&P, advancing 0.5%. Taylor Riggs, one more trading day to go to get to the weekend.
We are almost there, and let's talk about some of the economic data in the morning brief that we're going to be getting this morning as we count our way to 9:45. Let's start with some of the PMI data at that. Of course, we had the composite last time coming in at a 63.7. Look at services this time around a 64.5, and manufacturing, which is what we're looking at here, at a 62. So you're going to be looking for a steadying out after what has been a pretty big climb higher coming off of the lows of about June 2020. We change forward to push again back to 1 p.m. with the Baker Hughes rig count. Huge stuff going on within the commodities market. If you take a look at coins, soybeans, Arabica coffee hitting record highs. But then, of course, the oil market has been shaking up the space as well, with the Baker Hughes rig count data trying to see some rigs come back online. What does that mean for prices? And yes, John, finally, the Tokyo Olympics. They've officially started, but you actually made a good point. Some of the soccer stuff, it's already started. So you have like the official unveiling, but some of the stuff's already underway. I don't get it.
Why do we always do that? I don't get it either. I know whatever happens with our next guest, it doesn't matter how I start this conversation, Tom will restart the interview by talking about the Olympics. So let's head to Tokyo and start the conversation by talking about the Olympics, and then, Tom, we can move on from there, okay? John Vell, Nikko Asset Management Chief Global Strategist, joins us right now. John, can you talk to me about the degree of excitement in the city you're in right now?
Well, to be honest, the mood is pretty grumpy here because of the lockdown and all the trouble that's been affiliated with the Olympics, the to and froing from various edicts that have been put out. But essentially, a good number of people are quite happy it's happening. And of course, the athletes are very happy it's happening. And thank goodness that Japan was able to have the Olympics here. I don't think anyone else really could have done it, to be honest, at this stage. So it will be quite safe and secure. All the Olympics activities are happening in a bubble here, and a lot of people will be happy when it's over, to be honest here. And
I
then
think you might be one of them, John.
To...
I've got to say, Tom, that John Vell doesn't sound thrilled about what's about to take place in his city in Japan.
Well, that is the mood here, to be honest. If you're watching on TV, it's fun, but there is a sense of skepticism about the whole thing here. It's been sort of a burden for Japan,
right.
And it's caused a lot of bad feelings.
To a nation, John Vell, where symbolism is everything, is the emperor engaged with the Olympics? Is the prime minister engaged with the Olympics?
Yes, they are. They will be at the opening ceremonies, although a lot of people have dropped out, to be honest, like former Prime Minister Abe dropped out. And I think there's only about close to 200 people from Japan who will be attending the opening ceremony. So it's very pared down. I think there's about 600 or 700 foreigners who will be at it. So very pared down.
That's amazing. John Ferro, I'm sorry, your entourage is 200 people. That's incredible.
We couldn't go to the Olympics this year, I'm afraid, Tom. Yeah. We couldn't make it. Do you want to talk about markets, John? Should we do that right now? Let's pivot hard away from something that's clearly upsetting you, sir. This is no good Segui, Tom. Equity futures up 20 on the S&P. We're advancing 0.5%. John, it just feels really difficult to push back against this market. Even with the bond market doing what it's done this week, equities were still doing okay. The drawdown was what, 2, 3, 4 percentage points on the S&P. What is the bear case now through this year?
Well, I guess you'd have to look at what Tom was saying earlier. There might be a surprise out of the Fed. It seems like there are some very hawkish members who might dissent at the next meeting. There's also the question about who's going to be chairman going forward, and that's much more important than when the Fed starts tapering. And of course, Powell has the job if he wants to, but if he wants it, I think. But I think there's a chance that he might say, well, I've done enough and retire before things get any hairier. So that could cause some uncertainty, but it certainly doesn't seem like it's going to be earnings, does it? I mean, because I'm glad I'm not an analyst in the States. I mean, it's just embarrassing how much these companies are overshooting analyst estimates, isn't it?
John, the backdrop, of course, of all of this is a 10-year at a 129, and it was Nikolai Mai of PIMCO last hour saying half of it is some of the positioning and the technicals, but some of it really is fundamentals, a slowing down, concerns about the delta. What do you think?
Well, I think it is a combination of a lot of things. I think there's a lot of foreign buying, too, maybe especially from Japan. The data showed a lot of buying by Japanese banks, and I believe it was in June. And so there's certainly a lot of different factors going on, and people really believe the Fed when they say that the CPI is going to be coming down. There's a boatload of money out there that needs some place to be, and so they like to be in treasuries, almost regardless of the price. It seems it's certainly better than European yields and Japanese yields.
John Vell, in the Western world, you're one of the great Japan watchers. When you hear the word Japanification, the Japanification of Europe, the Japanification of the United States, is that a genuine concept for you?
I go back and forth on that, to be honest, a little bit. Japanification, certainly in terms of the economy, is not happening to the U.S. economy. I mean, the Japanese economy has been quite dull for quite some time. The U.S. economy has bounced back strongly, and inflation is back strong. Japan's been suffering from deflation or noflation, as I call it, for decades now, and that's not happening in the States. So there's some aspects that certainly can happen. Certainly the debt burden that's going up in the States is a form of Japanification, and perhaps some of the attitudes about how society works is moving a little bit more in Japan's way, a little bit more of the polite version of society as opposed to the aggressive side. So there are aspects. Certainly Japan has led the way in terms of monetary policy and started QE, started negative rates, all these things. So certainly Japan has some examples to show the rest of the world, for better or for worse sometimes.
And stuck down there for a long time. John, it's good to catch up. Good luck for the following month. John Farrell there, Nikko Asset Management Chief Global Strategist. Equities doing okay, up 20 on the S&P, advancing 0.5%. Let's bring in some of the research. This from Bank of America this morning. Global PMIs likely peaked in May. Euro area PMI is close to the top. This coming from their team, Tom. They go on to say cyclical catalysts for the US recovery are looking, quote, increasingly tired. So let's be clear about this. Not everyone is bullish on this market right now, Tom.
No. I would say that's consensus is I'm in the market, but there's a lot of that going on. John, you bring up a really important point of research published over the weekend. How much of the sell side is going to front run next week's tech juggernaut and get out front of it with adjustments? That's something to watch for over the weekend.
Well, I think to Taylor's point, after those numbers, after the close yesterday from the likes of Snap, the likes of Twitter, the bar's just that little bit higher now going into the likes of Facebook. Those numbers look good. Those stocks this morning look good. Your equity market advancing 0.46% on the S&P 500. Alongside Tom Keene, I'm Jonathan Ferro, together this morning with Taylor Riggs. Lisa will be back with us on Monday. From a beautiful New York City, this is Bloomberg.
With the First Word News, I'm Laura Wright. A bipartisan group of U.S. senators is closing in on a $579 billion infrastructure deal. They agreed to pay for it in part by delaying a costly Trump-era Medicare regulation. Details won't be announced until at least Monday, and any deal could face opposition from Democrats in both houses of Congress. The head of the CDC says the U.S. is at another pivotal moment in the pandemic. Rochelle Walensky says COVID cases are once again climbing and beds at some hospitals are filling up. The government says that by the second week of August, the number of new cases may be up 39% from last week. The job market has sprung back to life in London. Two separate surveys show it's become a hotspot for the first time since the pandemic closed vast sections of the economy. The Recruitment and Employment Confederation said London had 6 of the top 10 areas in the UK for new job postings last week. And the job search website Indeed says consulting and financial firms were among the top companies seeking staff in the city. Tokyo's Summer Olympic Games formally gets underway today, a year later than expected, and with no spectators in the stands. The coronavirus has been the latest and biggest challenge for the event, but not the only one. The Tokyo Olympics has been marred by everything from a scrapped stadium design to a bribery probe. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
Pandemic among the non-vaccinated, those who are not vaccinated. If you are vaccinated, you are safe. If you are vaccinated, you have over a 98% chance of never catching the virus at all. But the vaccines are good against all of the variants that are out there, including the Delta variant.
The CDC has called it another pivotal moment. That was the President of the United States. This is Bloomberg Surveillance, live from New York City for our audience worldwide. Alongside Tom Keene, I'm Jonathan Ferro, together this morning with Taylor Riggs. Lisa back with us on Monday. Here's the price action right now, and the S&P advancing another 21 points. There's a lift. We add some more weight to the benchmark in America, up another 0.5%. Yields all over the place this week. The only thing I can tell you is they're a little bit higher now than where we closed last Friday. 129.30, yields advancing a basis point or two. Euro dollar slightly negative yesterday. We add to it 117.64 on euro dollar. The dollar index just having a little look at 93 again. Outside of that, in the commodity markets, 71.95, 71.94, 93, just south of 72. We are unchanged on WTI, Tom.
Yeah.
But let's finish on this right here. TKDD once again getting absolutely hammered in the pre-market to 932, down by 8.63%. The mood is souring on these names. If you're a Chinese company listed in America, and if your name is DD Global, you're not having a good time.
Can you imagine the roadshow for the NASDAQ Golden Dragon China Index? They probably did Chinese takeout. I mean, you know, that's what you think. Down 35%. John, the chart looks like Bitcoin from 60,000.
It does not look
good. I mean, there's some real damage here. When does the litigation start?
I don't know, Tom. I think it's going to build up pretty quickly.
Yeah.
We still don't know a fair deal about what's going on here. Before we go, Tom, I want the Taylor Riggs take on this. Taylor, we've been talking about this now for about a month, and every single day just seems to get worse and worse for this company.
Seems like a stock that, IPO'd at 14 on 629. Since then, I think you've been trying to figure out the risks of China. I said this 2 days ago, and I'll repeat it. How much of our analysts that we're speaking with now are looking at EM ex China? Given some of the regulatory crackdown that's coming, how do you take this into account? And then the further headlines today, trying to put tutoring firms into nonprofits. I don't know how you invest with that risk of the unknown.
Really, really tough right now. DD Global, Tom, down another 8+ percentage points.
That was very good. I mean, Taylor was right there on the edge of Lisa. I mean, it was the pendulum of unknown. There's just no other way to put it.
You miss Lisa, don't you?
Yeah.
Is that your response? Shall I cut that and send it to her?
She's been gone so much, John. I don't know what it's like to,
You've forgotten what it's like to work with her.
Yeah,
I think you got a flavour of it just then, Tom.
Yeah, I think we did. I think
just a little bit.
Taylor channeled it nicely. Let's channel down to Washington. Emily Wilkins joins us here. Bloomberg Government, hot, steamy Washington, a July summer Friday. Emily, how do the politicians get to Monday? For that matter, how do they get to the Sunday talk shows? Does infrastructure lead the debate?
Absolutely. I mean, look, you've seen them at least come up with get over one negotiation hurdle. They were trying to figure out what spending was going to be. They didn't want to bolster the IRS to try and get more unpaid taxes. They came up with delaying a Trump-era rule on Medicare that was going to be real costly. So that's one agreement they've got settled. But look, at this point, there's still a lot left to negotiate. There's the balance between highway funding versus public transit. You're hearing Democratic senators come out with concerns now. Tom Carper of Delaware saying that he's concerned about funding for water. Other senators saying they have concerns about public transportation, about fossil fuel pollution. I mean, this is the moment where every one of those 50 Democratic senators realizes that they actually have the exact same amount of power that Joe Manchin does. And if they want to stand and oppose, that's going to cause a huge headache.
Primaries, Texas, March 1, runoff, May 24. How close is March 1, 2022 to the assembled politicians in Washington?
They still have some breathing room. I mean, usually how things work in D.C. is that in years like this, 2021, they can get legislation done. They're going to go probably right up to the end of the year trying to work on stuff and get things done. Okay. But when you hit 2022, you maybe have a couple months in the spring. But after that, campaign season really kicks in. And lawmakers get very hesitant to pass any sort of legislation or do anything that could result in a negative campaign ad. So the push really is coming now. And we're going to see what's happening here. Senators are supposed to depart for this August recess on August 9th. There's a chance they could stay longer. There's a chance the House could be called in. But at this point, we still, again, do not have text and do not have legislation on the bipartisan infrastructure bill, nor on the $3.5 trillion Democrat-backed reconciliation package.
So, Emily, walk me through the process now. What's lined up for next week? What does next week actually look like?
So if the bipartisan group of 22 senators is to be believed, they're going to have something on Monday. Monday is the deadline that we have set, and we have heard from them again and again. That's something I'm definitely going to be listening to for the Sunday shows to see if that target date is changing at all. Another thing that they've got coming up is the debt limit. I mean, the debt ceiling, debt limit suspension expires on July 31st. We heard from the CBO that they think they can use metrics for the U.S. to continue to pay its debts until October or November. But this is something that Democrats are going to need to move on. And you've already seen Republican Senate leader Mitch McConnell come out and say, hey, we're not going to be cooperating with Democrats on this. It's very unlikely that Republicans are going to be voting on this. So that's just another thing on Democrats' plate that you really need to watch for in the next several weeks and months.
Emily, with that debt ceiling, how close does it come down to the wire then in October, November, if we don't have an agreement?
It has the potential to come down very close to the wire because we've seen this happen in the past. We've seen a political football be played with this. We're seeing it again this particular time. I mean, Democrats they've expressed frustrations. They said, we went with Republicans during the Trump administration to raise it, and now they feel like Republicans should go with them. But, Mitch McConnell is trying to drive a hard bargain here, trying to see if he can get some things done, if he can use this as a negotiating tool. But yeah, there is a chance that we go past this July 31st deadline and we get into that period where the government is using these extraordinary measures to let the U.S. continue to pay its debts. And I can see us getting very close to that deadline. That said, lawmakers are very cognizant that what would happen if we miss the deadline would be pretty detrimental to the country. And so usually lawmakers do have a history of raising the ceiling before the U.S. is no longer to cover its debts.
Emily, thank you. It's good to catch up down in Washington. Bloomberg's Emily Wilkins, thank you very much. Start of the year, Tom. Washington, D.C. was the source of a tailwind for this market. Now increasingly, 6-7 months later, relatively speaking at least, feels like the source of some headwinds at the moment.
Yeah, I agree. But I can't get a handle on it. I mean, we all agree the nation desperately needs infrastructure. I guess we're arguing about how to pay for it. But as I mentioned in the primaries, John, I think what is underweighed here, and particularly by the business community, is the political realities of these primaries. All of these Congress people are fighting for their future.
And Tom, on the calendar, I think the calendar is an important point. For these congressmen, for the senators right now, they don't just want to pass a bill. They want to pass a bill where the money is deployed before the voting actually begins. This market will respond instantly. That money needs to hit the ground well before the voting actually begins. You need to see it in the data. That's what they want to see, Tom.
They will. John, did you see, if you got through season 1 of Ted Lasso? It's out.
No.
I haven't seen it.
Tom, I've got stuff to do. Wait for the market to close.
Tonight.
And I'll catch up.
Yeah,
Is season 2 out right now?
I believe it came out at 3 a.m. this morning.
I'll start watching it during the show.
No, you got to watch the first season.
This is Bloomberg. Live from New York City for our audience worldwide. 3 days of gains into Friday on the S&P 500. We're set to add some weight to it on a week of gains. So far, your equity market up 21 points on the S&P, advancing 0.5%. A similar story on the Nasdaq there, up by 0.48%. And likewise on a Russell, bouncing back after a rough ride more recently, advancing there by 0.7%. Helped out by the earnings. The numbers so far terrific, but that alone isn't enough. It's how the market responds to those better numbers, and you see that in Twitter this morning, advancing by 5-6 percentage points. If Twitter can do it, why can't Facebook? We raise the bar going into the numbers next week. Tuesday, Wednesday, big couple of days for big tech in America. Alphabet, Google up 0.8%, Facebook up by 2.9%. Keep an eye on that. The earnings have set the tone for the equity bulls. For everyone else, what's setting the tone right now is the bond market. Let's finish there. Switch up the board. Your 2s, your 10s, your 30s. We look like this. Yields are higher again by a basis point to 129.14. Yesterday, we had a look at 131. What on earth are we trading on that deserves a range of 112.60 at the lows on Tuesday morning and 131 on the highs on Thursday afternoon, Tom? What on earth has been driving that when there's been very little data in between? It's been a blackout period for the Fed ahead of that decision next week. So we've had no Fed speak, very little economic data to trade on, and a bond market just doing its own thing, apparently.
The bond market is a beast of its own. Again, the 2s10 spread, 109 basis points. That was below 100 basis points here not too long ago. And again, we're looking at earnings maybe as a separate beast into next week as well. Right now, a really important conversation and an appropriate conversation for summer. Long ago and far away, Carl Brunner and Alan Meltzer set up summer conferences. I will be direct. They invented the economic summer conferences. And the detritus of that has been the Shadow Open Market Committee, of which Mickey Levy has been a member for near 40 years. He, of Bank of America, now at Berenberg Capital Markets, is their chief economist. We are thrilled that Dr. Levy could join us this morning. Mickey, there has to be a fear, a singular fear, of the many shadows of our debt and our deficit. Except life seems great. How is that?
It's really quite striking how the public, the financial media, and financial markets seem to be ignoring the dramatic increases in the debt and not really questioning what its consequences are. Particularly, Tom, it's not just the piling up of the debt, but it's also, what are we deficit spending for? Are we allocating resources in a way that's adding to, productive capacity? And, I think let's get down to basics. One way or another, we and future generations are going to pay for it. We used to think it was all going to generate higher inflation and higher interest rates. It hasn't. That doesn't mean it's good. Once again, it gets to the point, how are you allocating national resources? And, it's going to lead to slower growth in the long run.
What would Carl Brunner and Alan Meltzer say about the two Americas we've been dealt, not only off the financial crisis of 2008, of which you were in the crosshairs of, but also this natural disaster we have? What would Brunner and Meltzer say would be a prescription across all of economics to get us out of this mess?
Okay, one thing they would say is, coming out of the current situation, the pandemic, the economic situation is completely the opposite of coming out of the financial crisis. It was the proper role of the government to provide income support during the pandemic, but now you don't need any more fiscal stimulus. You've already rebounded back, and you need to move back to normal, both in monetary policy and fiscal policy. On fiscal policy, they would completely agree with the notion that you need to allocate more resources to infrastructure that is really needed, but not more to stimulating the economy, which is not needed.
Mickey, you want us to focus on the debt pile, so let's do that right now. Why is it a mess to you? What is messy about it?
Well, I wish our policy leaders were actually debating the issues in a rational way. All we hear about is the number, $1 trillion for the infrastructure package. Also, the infrastructure package, please note, is called the American Jobs Act. It should be called the Infrastructure Act with an emphasis on infrastructure rather than creating jobs. There is little discussion at all about how the resources are going to be allocated, who's going to administer the projects, what projects are needed. That is, we should really be thinking strategically about how to upgrade and improve our infrastructure. Also, as you've noted, the infrastructure initiative, the American Jobs Act, is being tied politically to the American Families Plan Act, which involves a couple $1 trillion in various income support programs. And holding that hostage to more fiscal stimulus is just not constructive. And so we need to disentangle the legislation and have our policymakers address what is really needed at this time. We do not need more fiscal stimulus to create stronger economic growth. That's the old battle.
So, Mickey, your issue then is not the additional dollar of debt, it's what that additional dollar of debt is being used for. Is that a fair characterization of your position?
Oh, I think it's a combination. I mean, whenever you have the government debt to GDP rising above 100, you should be concerned. You should also be concerned when the Secretary of the Treasury says, the Fed is keeping rates at zero, so now's the time to spend more. That's not wise strategic thinking. So I'm concerned about the rise in the debt per se, but I'm also very concerned about what we're deficit spending for, and does that, quote unquote, pave the road for increasing productive capacity in the long run? Because it's the continued increase in growth in the future that allows us to finance or the debt service, and also raise standards of living.
Why isn't all the spending leading to inflation?
Well, it will. I mean, the risks are inflation is going to go up. So let me put it in a nutshell. Inflation has already risen significantly higher than the Fed had earlier predicted it would. Certainly, some portion of the rise in inflation is temporary as these supply constraints and supply bottlenecks dissipate. However, you have seen an acceleration of aggregate demand. Okay, now the critical issue is, after this initial spurt in economic growth as the economy reopens, following that, if all of the monetary and fiscal stimulus in the pipeline, which is unprecedented, if those policies actually stimulate stronger aggregate demand as they are supposed to, then you're going to end up with excess demand. And if those policies fail to work, then you're going to have the economy go back to where it was, and most of the inflation will prove to be temporary. But, the critical point is, the risks are for inflation to rise, and there's no question but that the higher inflation hurts lower income people the most. And what the Fed is doing is it's really accentuating income and wealth inequality, and it's really
Mickey,
not stimulating the economy.
Because of time, I want to get you in trouble with Berenberg in Germany. Tell me about the new Bundesbank from where you sit, and after watching Lagarde yesterday and the revolution of the ECB, is this a new Bundesbank?
Compared to a decade ago, of course it is. The ECB, when it was founded, was the Bundesbank was in the driver's seat, and it held to its old precept of stable money and stable price levels, and now the ECB is. It's in an awkward situation, but it's all about, financial stability and continuing to ease and continuing to have its eye out on the weak links in the European Union. That means continuing with its QE and negative rates. And so, yes, and of course, under Lagarde, they've expanded the scope of the objectives of the ECB to include climate change, some credit and distributional issues. So yes, it's a different policy making body than it used to be.
Mickey, it's good to catch up. Just the flavour of the heritage of Berenberg there with Mickey Levy and Holger Schmieding on the other side of the Atlantic. Mickey Levy there of Berenberg. Tom, the issue that I think the Hawks have right now over in Europe is we all want to get back towards 2%, but do we really want to argue over 20, 30, 40 basis points and have this long-term commitment to extraordinary policy of deeply negative interest rates and QE forever? Because that's what's happening here. And I keep going back to what that PEP program is. The E in PEP is emergency. And what President Lagarde did not give people what they wanted to hear yesterday was how they constitute the end of that emergency. And we haven't got anywhere near to describing that.
John, I did the Ibbotson chart going back to before the Depression with Francine this morning, Roger Ibbotson's wonderful chart from Yale University. John, the thundering silence of this great disinflation has been how we haven't been able to get near an academic construct of 2%, pandemic, crisis, whatever, and that there's a rationalization out there about potential GDP under 2%.
Next round of forecasts from the ECB, they will be very,
and from
very
the
interesting.
Fed. Yeah, well said. Yeah, and the Fed too.
1.4% for 23 rather.
I'll let you forecast.
1.4% on CPI. That's not mine, Tom. That's for the ECB.
I'm going to forecast. You have to watch Ted Lasso the whole season.
The whole season this weekend.
Before before you watch season 1.
And I'll come in Monday morning unprepared.
Yeah,
How's that?
I believe.
That'll be 2 of us.
Gotta
On the
believe.
S&P up 21. We advance a half of
believe in
1%.
surveillance.
Yields 128.97. This is Bloomberg.
With the First Word News, I'm Laura Wright. Talks between the European Union and the US on vaccine passports are making little progress. Bloomberg's learned that's because there's no federal certification program in America. The EU launched its COVID pass at the beginning of the month. The bloc is at an advanced stage of talks on the vaccine passport with the UK. Colony Capital founder Tom Barrack is back in federal court in Los Angeles today. The Trump ally will learn whether he will be released on bail after being charged with illegally lobbying for the United Arab Emirates. Prosecutors say Barrack is a flight risk. His lawyer says he's not guilty. The state of Mississippi has asked the Supreme Court to overturn the constitutional right to an abortion. That raises the stakes in a clash the justices are set to hear in their upcoming term. Mississippi calls the 1973 landmark Roe v. Wade decision that legalized abortion egregiously wrong. Intel says the worst of a semiconductor sales slump has passed, and CEO Pat Gelsinger is sounding bullish about the chipmaker's prospects for the rest of the year. Intel's most lucrative business, server processors, picked up in the second quarter from the first. Still, investors worry that the division's 9% decline in sales may signal a long road to recovery. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
We recognize how very, very difficult this has been, and we come here humbly and with respect for our Japanese hosts. And again, we will follow every protocol, we will follow every rule to ensure that this is a safe and secure games for everybody.
That was Suzanne Lyons there, the United States Olympic and Paralympic Committee chairperson. And I have to say, a very different mood going into this event compared to the Euro Championships just a month or so ago. From New York City this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro, together with Taylor Riggs. Lisa back with us on Monday. Here's a flavour, a taste of the price action, up 21 on the S&P, advancing around about a half of 1%. Into the bond market, yields are higher by a basis point or two. 129.47, had another little look north of 130 earlier, just south of that level now. Euro dollar unchanged at 117.68, and crude just slightly softer, negative lower, Tom, down 0.25% to $71 and about 70 cents.
There's a lot of statistics out there, John, on cases, hospitalizations, and death. I'm not sure what to make about them as an amateur. Let us speak to a pro here. And the emotion of this third leg of the pandemic. Andrew Peckhoff joins us now from Johns Hopkins. Andrew, John Farrell mentioned Louisiana is particularly difficult. Louisiana cases are back to February 2nd. California is back to March 2nd. Do you as a pro care about the case increase, or do you still consider hospitalizations and deaths?
I think both are important. I think it's even more important to emphasize the fact that the vaccines are protecting against the severe disease and the hospitalization that was really driving such a crisis in our medical community during the peak months of this pandemic. Case numbers are important to follow because we want to make sure that we want to follow the case numbers in vaccinated people and compare it to unvaccinated people to really figure out what's driving the infection. So the most important number is really disease severity, hospitalizations, and protection from death. But case numbers are important because the more this virus replicates, particularly this Delta variant, the more likely we're going to see more variants emerge from it that might be better at infecting people and perhaps eventually getting around the vaccine immunity.
Explain to the unvaccinated the disease severity of, say, a 32-year-old admitted to the Johns Hopkins Hospital this morning.
Well, early in the pandemic, there was some feelings that if you were young and healthy, you were much, much more likely to have a very, very mild disease. We're seeing those numbers increase very, very significantly. And vast majority of people that are hospitalized right now are under the age of 65. So that population that initially thought that their disease severity was a chance of severe disease was very low, that's starting to creep up very significantly. And so this virus, particularly this Delta variant, is changing the course of the disease and the age groups that are susceptible to the disease. Now, we're not at the levels that we saw in the winter because we've protected the most vulnerable portions of the populations with the vaccine. But if you're young, you have a much, much greater chance of getting severe disease now if you get COVID-19 than you had in any other part of the pandemic.
Professor, I want to work through some numbers with you. This came from Israel's health ministry. And the number that a lot of people will hear this morning is the number 39%. 39%, the Pfizer-BioNTech vaccine effective in preventing infections. What is often in the next paragraph is the more significant information. The number 91%, 88 to 91% protection against severe disease. And Andy, I think emphasis matters here. And I cannot believe that 18 months into this mess, we're still reporting things the way we are reporting things right now. Surely we need to focus on the latter and not the former. Andy, do we still have an information problem, an emphasis problem in the way that these numbers, this data is delivered to the public?
In some ways, I think we do. The Israel report is also a little bit interesting from the perspective of their protection number against symptomatic disease is much lower than numbers that we're seeing coming out of the UK, out of Canada, and out of the US. So the commonality across all of these studies is that there's 90+% effectiveness against severe disease if you're vaccinated, and that's against the Delta variant. When it comes to symptomatic disease, the numbers seem to vary. Israel's coming up much lower than other countries, so that needs to be investigated. That may be telling us something important about the immunity from the vaccines, but at the end of the day, it's protecting against severe disease that is the critical issue, and the vaccines continue to perform at an excellent level against that parameter.
Do we need to follow Los Angeles in mandating masks indoors, even for the fully vaccinated?
It's a question of risk. When you're vaccinated and there's not much virus in the community, masks really don't add much to your protection. But if you're vaccinated and you have a lot of virus in the community, then you have a chance of getting symptomatic disease. The data right now is showing that even if you get infected when you're vaccinated, you're probably less likely to spread the virus, but it's a question of risk. And if you have a lot of spread of the virus in your community, I don't think there's anything wrong with wearing a mask to have that extra layer of protection, even if you're vaccinated.
And I guess the bigger question right now is whether that should be mandated or whether that should be individual choice. As you pointed out, we've done a great deal in this country to vaccinate the most at risk. Do you think we're at the point now where this is about going back to where we were before, shifting the goalposts again and saying this is about protecting the healthcare system, or is this about individual risk?
Yeah. My personal opinion, we have so much data on the safety and the efficacy of this vaccine, particularly the mRNA vaccines, that these vaccines should be moved into full approval by the FDA, and then we should really institute much greater vaccine mandates across this country. These vaccines work. These vaccines are safe. They are the path out of this pandemic. And we just have to get better at giving these shots to people and getting people to accept them, because they really do work despite the misinformation that is out there and being spread like wildfire on social media.
And Andy, as much as we like each other, I know you and I both can't wait to stop talking to each other on a weekly basis about this issue. Andy, it's good to catch up. We appreciate the hard work. Thank you, sir. Andy Pekos, Johns Hopkins University Bloomberg School, a public health professor and virologist. Tom, I mean it. I know you mean it too. I can't believe we're still here, July 21, having the same conversations.
We're still here, and I'll be honest, it's going to be an interesting weekend. There's some serious issues out there. Just on a micro basis, some of the kids off at camp in New England here in New York, and I'm sure that's a nationwide story, and the stress is on essential workers. But, John, you brought to my attention the explosion in Louisiana of cases. I've got to see how that folds over into hospitalizations.
Well, I can tell you,
these are real numbers.
They've almost doubled in a week.
Yeah.
And those numbers aren't pretty.
They're back to February.
And Louisiana is the third lowest state the third lowest amount of vaccination, the third lowest rate of vaccination in America among states here. It's not good enough. It's going the wrong way. And I think at this point now, Tom, it's about, for markets at least, because we need to have that conversation on a program like this, how do consumers respond? Do they lose some confidence? Haven't seen big signs of that just yet. How do corporations respond? Do they start to delay the return to work in a more material way in this country? That's going to be interesting.
Buried in the news flow, the National Football League, John, this is the American Football League, said basically if your guys get COVID and you have to forfeit, you lose the game.
I saw that.
Yeah.
Coming up, Stuart Kaiser on this equity market, UBS head of equity derivatives research from New York. Equities with a lift, up 0.5% on the S&P 500, advancing 21 points. From New York, Tom Keene, Jonathan Ferro, Taylor Riggs. This is Bloomberg.
We have an economy that's going to continue to grow, but the largest gains may be behind us.
Almost everything has told us here that we're in a regime shift. We're going to now see growth decelerate and inflation decelerate.
We are going to see a deceleration in growth, that's for sure. But I think the U.S. consumer will stay quite resilient.
The recent move is overdone. You're going to have a push higher for the remainder of the year.
You're not going to see deceleration until sometime into next year. There is still plenty of room for the economy to run.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
We are ending the week with a lift from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Tom Keene, I'm Jonathan Ferro. Together this morning with Taylor Riggs. Lisa back with us on Monday. Your market up 21 on the S&P, advancing 0.5%. Tom, 3-day winning streak into Friday. We could add some weight to it.
Yeah, the equity's really de-linked. I mean, bonds half asleep here. The 10-year yield 1.29%. But equities have a life of their own. And, the bottom line, I think Taylor's better at this, John, than I am. Earnings are speaking volumes.
Amex with numbers right now, Tom.
Look at their revenue
Upside
number.
surprise, 10.24 billion revenue. The estimate 9.64 billion. And Taylor Riggs, the numbers yesterday afternoon, just as good.
Unbelievable. I think Rohit Kulkarni of MKM Partners has the headline note of the morning saying Snap defies gravity. It's a beat and a raise. That pretty much just sums it up as people are taking a look at the difference between Snap and Twitter follows at a slower pace. Snap, they're saying, has just been set up for a decade-long cycle.
Fast forward to Tuesday, Tom. Apple, Microsoft on deck. Big tech, big earnings kick off.
Well, a reset there. Anurag Rana, who's really quite good at Bloomberg Intelligence, just walks through the revenue dynamics of Microsoft. This is a small company out in Washington State. And John, Rana says of Microsoft simply the fourth quarter revenue mix, if you will, he's got an above consensus view on that.
That stock year to date, Tom, has absolutely flown to the moon. Up almost 30%, positive 28.65%, and on course for a 10th consecutive year of gains. What a turnaround, Tom. We often reflect on that. What a turnaround of that company.
Yeah, let's review this, John. I think it's a good point to stop here on a Friday. We're trying to reframe for the week. The big missed call so far of this year has been NASDAQ. It's dead. It's over. It's done. Don't be in big tech. And I don't know, John, when was it? 6 weeks ago, like a switch, it went off.
Oh, yeah. A couple of months ago. All-time highs coming into the session this morning. Here's a flavour of the price action right now. The S&P up 21, advancing 0.5%. We'll talk about the Russell in a moment, Tom. The small caps with a nice little lift over the last couple of days as well. Bouncing back from an ugly few months. Outside of that, into the bond market, yields are higher by about a basis point or so. Still south of 130. Had a little look at 131 yesterday, 130 again today, 128.80 right now. And into foreign exchange, Taylor euro dollar 117.65, negative 0.05%.
And how much does that fold into some of the morning briefs that we're continuing to look at starting at 9:45 when we push forward to some of the PMIs? Remember, last time you had a composite reading of about 63.7. Look for services at 64.5, manufacturing at 62, coming off the lows of June 2020. But how much of this is really bringing up those calls of peak growth that might be behind us? Let's find out as well when we push forward to 1 p.m. We're going to get the Baker Hughes rig count. There's been a lot going on. I think Arabica coffee is now above $2 a pound. But if you take a look at the oil markets, a little bit of a different story as we're trying to figure out where we are at about, well, 48 $78, $68 a barrel as I try to catch my words. Let's change up the board and go back over to Tokyo Olympics. John, it was John Bale at the top of the last hour saying that the mood is pretty sour as you take a look at where we are within the Olympics. Unfortunately, some of it's already kicked off and there's been a lot of controversy, and you really wonder if this year is different.
And John sounded very upset, didn't he, Taylor?
Yeah, sour mood.
Would you say that our guest sounded sour? Would you go that far? Sour, grumpy.
Sour mood.
Not happy about these Olympic Games taking place in his hometown, that's for sure. Taylor Riggs, thank you very much. We're at a pivotal point right now for this pandemic, for the surging cases, for policy, and for the outlook too. Let's talk about downgrade risk with Stuart Kaiser, UBS Head of Equity Derivatives Research. Stu, Q1 was all about upgrade risk. And now I'm just wondering whether we're at that inflection point, thinking about next year and maybe bringing things in just a little bit and trimming. What is your take, Stu?
Yeah, look, good morning, Jonathan. I think the risk here is to some degree downgrade risk, and also just, we had a lot of very good news priced into the first half of the year. Growth was both stronger and earlier, I think, than a lot of folks expected. And now that you have the Delta variant kind of popping up, I think people view that as a potential headwind on global growth, which could, of course, ultimately lead to some downgrades in U.S. growth as well. So I think there is that risk there. You have a natural just sort of slowing in sequential growth. You're not going to keep growing at 10%. And now you could argue you do have some headwinds that, at bare minimum, probably put a little risk reward around that number and could definitely lead to some downgrades. And you mentioned Snap before, kind of beat and raise story. I think, the U.S. economy was a beat and raise story for a really strong period of time. And if you go from beat and raise to just beat and you don't raise, sometimes investors don't like that either. So I think that is definitely an underlying risk in the market.
Well, let's talk about where to park the cash and make it as simple as we possibly can. Got the Russell on the one hand. Tom pointed out the recent gains we saw in the Russell Tuesday, Wednesday. Nice rally. Yesterday, not so pretty. You've got the Russell on the one hand, the NASDAQ on the other. What would you be sitting in now through to year end? NASDAQ 100 or the Russell?
I think at least tactically, we're still in the NASDAQ side of that camp, at least through earnings. We viewed small cap, frankly, for the last few weeks as the area you wanted to be hedging in. So, and I think until we get enough confidence that the global growth hit is not going to be too strong, from what we're seeing from a Delta variant perspective, I think we'd probably stay on the NASDAQ, side of that. And real rates in particular are something we've got an eye on. Lower real rates obviously would generally read positive for equities, but I think they declined so far and so fast that it started to, raise the question of why. And I think we like at least some answer to that question of why before we got too excited about getting back into that cyclical small cap at this point.
Stuart, on derivatives and on the cross moments, I put kurtosis in here as a joke, but, more on skew. What do they do when there's a lack of breadth? We can clearly identify there's minimal breadth in this market. What does that do to the derivative dynamics?
Well, Tom, look, I think it raises the risk of a pullback. People get uncomfortable with the sustainability of the rally, and that's definitely going to push the cost of hedge protection higher. And I think there's a number of things at play there. The first is this global growth story. The second is the event risk and the fact that the Fed sort of introduced two-sided policy risk into the market, last month. And yeah, in our view, that's going to keep skew elevated and implied volatility elevated, but probably more so in that 3 to 6 month space. Yeah. Whereas the front is going to still continue to be driven by short-term market performance.
So to translate that, what's the street bet right now out 3 to 6 months?
The street bet, I think the street bet 3 to 6 months out is, cautiously optimistic or, trust but verify. And what you're seeing there, I think, is a positive move, generally speaking, in U.S. equity markets. We're near all-time highs, but volatility and skew is high. And I think that's telling you people are willing to own it, but they want to verify that these risks are not going to come home to roost. And for that reason, that's why you're seeing that skew stay high, in my opinion.
Stuart, are we hedging and where then?
Yeah, look, I think right now, given the signals we're seeing from the bond market, it's prudent to have some hedging on. We have been pointing people towards small cap U.S. equity because, we thought that was the part of the market that was most vulnerable. It's gotten a little expensive to hedge there. So I think you could, just make the argument to just hedge an S&P and not get too cute with it. But I think you are, hedging in the equity markets, and we think small cap is the best place to go based on its exposures. So probably small cap or S&P is where you're doing that. And, we're seeing most people keep that relatively short dated because that longer term hedge protection is so expensive. They've been kind of forced to keep it fairly tactical.
Can you hedge with a 10-year to 128?
Well, and honestly, that's a huge question here, because the correlation between bonds and equities is sort of at a transition point. And I think a lot of investors are now asking, are bonds actually a hedge to my equity portfolio? If they're not, that means you have to hedge equities within equities, and the natural implication there is that pushes the cost of hedging and skew higher. So, it is sort of a circle you get caught in, sort of a negative feedback loop. But we'll see how it goes.
That's a great Friday conversation. John, I've never observed, does anyone hedge the Dow Jones Industrial Average?
I'm not sure. Is anyone allocated to the Dow Jones Industrial Average? Stuart, do you want to weigh in on that? Tom and I, and this debate that we continually have over who's actually allocated to the Dow and whether we should even talk about that index anymore.
Gonna plead the fifth on that one. I would say I haven't seen the Dow hedge go up in quite some time, but if it matters for Main Street, it matters for me, guys.
There we go.
Oh, Stuart, don't let me down. Okay, Stu, let me put you on the spot. Do you have a Dow forecast at UBS? Does one exist year-end?
Higher? No, we do not have a formal Dow forecast. I'm sorry to say.
I'm not going to let this go. Stuart Kaiser of UBS, Head of Equity Derivatives
this is great.
Research. Thank you, Stu. Tom, I'm with you. It sets the mood of the country. My view is that it shouldn't, but there we go. The equity market up 20 on the S&P. We're advancing 0.4%. There's a lift again this morning, Tom.
Yeah, what does Taylor Riggs think about a show where we can make jokes about skew and kurtosis? I mean, they don't do that on the close.
I think they probably do, Tom, if you tune in sometimes. Taylor?
Trying to do more skew and kurtosis.
Are you trying to make it
That's
happen?
all I'll say.
Yeah? You're getting pushback?
Yeah. These are really important
Sounds
things.
like Taylor Riggs getting pushback, Tom.
Of course, I always push back from Taylor Riggs, but these are really important things to the pros, folks, because what they're doing is they're hedging and bringing in premium or money to make their trades more cash effective, where they don't put a lot of cash out. That's the way the game's played, John.
Well, let's try and make the moment that we're in as simple as we possibly can. Rochelle Walensky, Tom, the CDC director, came out yesterday and said that we're in another pivotal moment in this pandemic. And I would go one step further, not just the amount of cases that we're seeing, but for policy and the outlook as well. And we touched on it there with Stuart Kaiser. After seeing this huge upgrade, this flurry of upgrades through Q1, are we at that moment now, Tom, when we approach September, October, and we start thinking about, OK, show me the money, show me the data. Been waiting for this moment, Q4, the end of the year, when the additional UI expires, the return to school is set to take place. Once we start to see that data, that's when you can really start to shape a view on 22 and beyond.
That's a belief. And Michael Purvis says he's enthusiastic about Q4, which is how he gets to Standard & Poor's 4,800.
We'll have that debate in the next hour with Sam Stoffel of CFRA, the Chief Investment Strategist from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro, together with the wonderful Taylor Riggs. Your S&P 500 up 20. We advanced 0.45%. And in the bond market, Tom, just south of 130 at 128.47. This is Bloomberg.
With the First Word News, I'm Laura Wright. A bipartisan group of U.S. senators is closing in on a $579 billion infrastructure deal. They agreed to pay for it in part by delaying a costly Trump-era Medicare regulation. Details won't be announced until at least Monday, and any deal could face opposition from Democrats in both houses of Congress. The head of the CDC says the U.S. is at another pivotal moment in the pandemic. Rochelle Walensky says COVID cases are once again climbing and beds at some hospitals are filling up. The government says that by the second week of August, the number of new cases may be up 39% from last week. A new survey says the Fed will start scaling back asset purchases next year, and policymakers are likely to put an emphasis on mortgage-backed securities. Economists surveyed by Bloomberg see the Fed raising interest rates at a quicker pace through 2024 than previously thought. Most also expect Chairman Jerome Powell will be nominated for a second term. Carlyle Group is seeking to raise as much as $27 billion for its latest flagship fund. That would be the industry's largest ever private equity pool. Bloomberg's learned Carlyle is in discussions with investors about the size of the fund. It's likely to include a strategy for growth-focused companies. And we know what Tom Keene will be watching this weekend. Yes, Tokyo Summer Olympic Games formally gets underway today, a year later than expected, and with no spectators in the stands. The coronavirus has been the latest and biggest challenge for the event, but not the only one. The Tokyo Olympics has been marred by everything from a scrapped stadium design to a bribery probe. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Laura Wright. This is Bloomberg.
We were in a position where the United States invested more money in research and development 3-4 decades ago than any nation in the world. Now we're number 8. We have to win the competition for the 21st century. That's really what's at stake.
The President of the United States from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro, together with Taylor Riggs. Lisa coming back to work, I understand, on Monday. This is the price action this Friday. Good morning to you all. Your equity market with a lift once again. 3-day winning streak into Friday. We add some more weight to the S&P, up 19, advancing 0.4%. Outside of that, yields just a little bit higher on a 10-year to 128.47. I'll get my words out, Tom. Up about a basis point on the day. Switch up the board and get to a stock to have a look at. DD, absolutely getting crushed. Can we say crushed if you're down 10%? I think we can.
I think we can, yeah.
Down 10.39%. And coming into Friday, Tom, down 26% from its IPO price. Just pretty ugly out there.
Yeah, from the peak, I think it's like a 35% move. And John, I wonder what the ramifications are, less for the Chinese, but much more for the American banks that efforted all
Yeah,
this.
Tom, look, I don't know much here, but the questions are as follows. What did they know? What were they told? And what did they not disclose to investors ahead of this IPO? They're the answers we want to hear.
Yeah. One other thing I'd note on the equity markets, John, the VIX gives me a 16.98. That's a big deal in this bull market.
Well, especially from where we were. Where were we, Tom?
25.
North of 20?
25. We come in 9 big figures off the growth scare. You remember the growth scare?
I remember it. I remember you calling the end of the growth scare. Are we done?
Yeah, we're done.
We moved on?
I missed my window of opportunity to get into the market.
Well, looking at those earnings, it looks like we're done, Tom.
Yeah.
Those corporations, the C-suite, seem pretty optimistic about the year ahead of us.
Edward Hyman with us later, our conversation of the day, and we're thrilled to bring you Peter Hotez on the pandemic as well. Right now, from the White House, Mario Parker joins us, Bloomberg White House reporter. Mario, I want to go not narrow here. I want to go bigger. What's the mood at the Biden White House? I think the nation was riveted by the mood of the Trump White House. What's the day-to-day and into the weekend mood of the Biden White House?
The mood right now, Tom, is one I would characterize as cautiously optimistic. President Biden, both publicly, has said that he's feeling good about getting his infrastructure packages across the finish line, even after the minor setback earlier this week. Aides behind the scenes feel just as confident as well. So, I mean, there's the caveat that anything can happen in Washington, that the coalition is tenuous, but the mood is overall cautiously optimistic that they'll get his big legislative package across the finish line.
What is the style here? I recall President Obama quaffing a beer on a hot summer day out on the lawn. I vaguely remember that. I think it was a Genesee Cream Ale. That's a quality beverage, Mario, from Western New York. It's not like the beer that made Milwaukee famous. But Mario, what's the method here for the Biden administration? Is it that Senator Biden has a certain rapport, or is there a different approach?
No, you summed it up perfectly, Tom, with the Senator Biden. We have to remember that he's been in Washington for the better part of 4 decades now. He feels very, very confident about his ability to reach across the aisle. And they've tried to really take the temperature down. Whether or not they've been successful in doing so is another question, but the aim has been to take the temperature down from what we've seen over the last 5 or so years in terms of partisanship, and try to at least have a public tone of some kind of cooperation and collegiality. It seems, again, that this strategy may be working if we're to look at what's happening right now with this infrastructure package.
Mario's a Chicago guy, Tom. That's Miller Lite. Miller Lite is the beer of Chicago. Have you forgotten that, Tom?
It's the champagne of bottled beers.
That is the champagne of bottled beers. That's right.
Of the White Sox.
Mario, I know you're a White Sox fan. We'll get to the baseball a little bit later. Let's look ahead to the next couple of weeks. I keep asking this question. It's important. I was told it was about days, not weeks, not months, and it's been weeks and months, and I'm wondering what next week is. How significant is next week, Mario, for you?
next week is huge, right? So you've got both Republicans and Democrats saying that something needs to get done toward the beginning of the week in terms of a bill text, right? So the setback this week revolved around Republicans balking around about voting for a bill that they hadn't seen the text for. Mitt Romney has said that they're looking at maybe Monday, possibly Tuesday or Wednesday for that to come. But as you mentioned, Jonathan, the clock is ticking, right? We have the vaunted August recess coming up here in the next few weeks. So Congress has to get something done. When we get on the other side of that recess, the clock starts ticking toward midterms when the political risk is escalated.
Are you still thinking that this two-pathway approach on this infrastructure deal is the way that we're moving forward?
No, absolutely. It seems to be that way, Taylor. President Biden has endorsed both tracks. And again, Republicans, while they have balked at the reconciliation path, the Democrats seem to have everyone on board. Now, the challenge for President Biden is pleasing everyone within his party, right? They have that slim edge with Vice President Kamala Harris holding that deciding vote. So he has to keep the progressives in line, the moderates in line as well within his own party. And that's where it becomes more of a tightrope for the president.
It's a backstory this weekend, Mario, but it is part of the Beltway. The president talking about the former governor of Virginia, Terry McAuliffe, is making another run at it. Does the president enjoy going out and campaigning?
Yes, it's in his wheelhouse, Tom. Later on today, he'll be going over to Arlington, Virginia, to campaign for McAuliffe. This is more in the president's wheelhouse. Again, as we mentioned, he's been in Washington for a long time. He's been a senator for a long time. When we're out in the pool with him, he takes a very long time after his speech to do a lot of glad handing, to do the rope lines, taking selfies with people. That's really where his comfort spot is.
Mario, before you go, we won't talk about Red Sox, Yankees. Let's talk about White Sox. Are they getting it done?
I think so, Jonathan. I'm pleased with the way Anderson has been swinging his bat as well. So I'm pulling for those guys on the south side of Chicago.
There we go. Bloomberg's Mario Parker outside of the White House. Good to see you, Mario. Thank you, sir. Tom, do you want to talk about Red Sox, Yankees, or do you just want to move past that?
White Sox baseball,
yeah.
Opening day, I believe 1965, can't remember.
Were you there? The
great Nellie Fox. I was there at Comiskey Park. It was the one park that felt like an old stadium. I didn't see many of the others, but it was I'm sure there's an English equivalent, John. It was a magisterial thing from the 1930s.
I think it's sad that some of those old stadiums are going, Tom.
Yeah.
You know?
Like the Toronto Blue Jays are playing in Buffalo right now, and I'm sorry, the old stadium in Buffalo where they filmed The Natural with Robert Redford, again, there's something about those old stadiums.
West Ham fans are not happy about the new stadium.
Yeah, exactly.
Liverpool holding on to Anfield. I think that's what people want to see more of. The fans like it.
You know, and I think AFC Richmond, I just love what they've done.
I'm going to tune in for that. I was teeing you up
Richmond
there, Tom.
looks a lot like what they did with Crystal Palace.
But isn't that is actually Selhurst Park, isn't it?
I believe
I think it is. All right, I look
if you
forward
watch
to that.
Season 1,
I will
you'd have
tune
a better
in just for you,
understanding.
Tom. I promised you I would. Your S&P 500 up 18 points, advancing 0.4%. A 3-day win streak into Friday. We could add to that and make it 4. Outside of that, 128.97 on 10s. From New York, this is Bloomberg. Live from New York City for our audience worldwide on TV and radio. Here's the price action this Friday morning. Good morning. 3-day winning streak into Friday. We can add some weight to this S&P 500. We're doing that right now. Advancing 17 points, up by 0.4%. Nice run on the NASDAQ as well. The NASDAQ 100 back to an all-time high. We could have a little look at an all-time high, a record on the S&P 500 in and around the open if we keep this up as well. Your NASDAQ 100 this morning advancing 0.4%. The Russell up by 0.6%. And the debate right now, we're at a little bit of an inflection point going into the back end of this year, waiting for that data around the September-October period where the additional UI expires, the additional unemployment insurance, and a back to school is set to take place. Will it take place? That's what I mean by this pivotal moment.
Next week's
the CDC is
Absolutely.
really alluding to, Tom. So where do you want to be? Where do you want to be right now? The NASDAQ or the Russell? Stuart Kaiser of UBS. He's going with the NASDAQ into that one. Switch on the board and get to the bond market. Speaking of the unknown, I think this is just the perfect way of capturing it. 29.03 at the close on Friday, on a 10-year, last Friday. Right now, 28.97. Lows of the week Tuesday, 112.60. All over the place on what? No data, no Fed speak, just the market living its own life. And Tom, I have to say that just speaks to the uncertainty in this market right now. The fact you can have a range that wide with no real catalyst, I think tells you a lot.
Let's admit we had a growth scare.
Do you think we're still in one?
No, but
what kind of growth scare is that? Okay, Tom.
We had a Delta variant growthy scare.
The growth scare outside of the price move itself?
I think on a global basis there was a legitimate, normal fear of a growth scare, and once again, buy the dip, won out.
Why? Because of the earnings? Or do you think the data's turned? Has something magically happened and that growth scare has disappeared?
I'm not smart enough to give you the why on that. Yes, the earnings are visible and all that, but it was sort of like a cosmic thing. You cover that in CFA level 4.
Okay.
Like
I'm going to leave that there, Tom. Let's finish on euro dollar in the FX market. Switch up the board and get to foreign exchange. We're going to have a nice conversation in a moment with a man that knows a lot about this FX market and the ECB. I'll keep this short and sweet. Euro dollar 117.55, just a touch weaker. That's the FX market. Let's get you some movers. Big week coming up next week with tech earnings on deck. Good morning, Romain.
Hey, good morning. And we got a little bit of a preview of maybe what to expect. Definitely a growth story, not a growth scare, or at least with regards to some of these social media stocks. Snap earnings, that's really what we want to pay attention to here. This is the biggest mover out there based on volume. It's the biggest mover out there based on percentage gain on the day. Snap having a phenomenal morning right now, up about 17%. This is going to be the best day for the company, should this hold, going back to October of last year. And I bring that up because last year was when they had that blowout third quarter where they reported 52% revenue growth. And everyone said, this ain't sustainable. Just don't buy into this. And what happened? The quarter after that, they had sales grow 60-something%. The quarter after that, they rose 66%. And in the most recent quarter, Q2 that we're talking about, they grew 116%. This is a story not only about Snap, but really about a broader move in digital ad spending that is lifting Snap, it's lifting Twitter, Pinterest, and of course, next week, we're going to hear from Alphabet and Facebook, and most likely it's going to lift them as well. These are your big movers on the day, and most likely this is what's going to carry us into next week, at least as far as the tech stocks are concerned. Now, there's another story going on out there this morning that I think is flying a little bit under the radar. This is another story with regards to Chinese regulation, and now it involves a lot of the education companies over there. TAL right now down about 53% here in the pre-market. These are the ADRs. GSX Tech2 also down about 58%. All of these education stocks are under trouble right now because of a story out by Bloomberg saying that the Chinese government is actually going to force these for-profit education companies to basically go nonprofit. This would effectively completely neutralize this industry and is not exactly unheard of. Back in April, the Chinese government hinted at this. It fined a lot of these companies for what it said were unfair pricing practices. So investors had already started bailing out. Remember, TAL was down about 71% prior to today, year to date. But this is having big reverberations for a lot of the other Chinese ADRs, Didi, Baidu, JD.com, Alibaba. Keep an eye on all of those names today. A big story with regards to Chinese regulation.
Romain, thank you so much. To close this afternoon, Romain Bostic, among others, will be there. I do want to point out Euro sitting right on support right now, 1.1759. We'll get to that in a moment. With Vasilios Giannakis, he's Bank Lombard Odier, global head of foreign exchange strategy, and he has a single line in his report that makes any and all lean forward. Vasilios, you see strong Chinese currency, renminbi from a 647 stronger to 6.30 yuan per dollar. Let's start with the why. Why do we see such a strong move?
Well, it's a confluence of things, really, Tom. It has to do with domestic fundamentals. Look, there has been some signs of slowing down, but nonetheless, the Chinese growth is still going to cruise along nicely in the second half of the year. The other thing we have to bear in mind, there are a lot of sticky flows that are flowing into China right now. And this is because of the introduction of a number of Chinese assets into benchmarks. The other thing that's playing out quite interestingly is that Chinese exporters have been sitting into an unusually large pile of dollars over the past 8 to 9 months. And whenever we have had that episodes in the past, which coincided with periods of crisis, it eventually led to a significant unwinding of that big pile of dollars and conversion back into the renminbi. So the confluence of all these factors and the fact that, global trade is spinning out very, very strongly. If you look at global trade volume year over year, it's just rising at an astonishing rate. This thing is meant to normalize. Of course, the momentum is not going to be there for the indefinite future, but nonetheless is going to remain a supportive factor for the renminbi. And on the other hand, you also have dollar overvaluation across a broad range of currencies.
So where does this fit into the euro call right now for you and the team, Vasilios?
Look, I don't think the ECB yesterday is a make or break for the euro. I think everyone was pretty much positioned and everyone was expecting for a very dovish message. If they didn't get it, as a matter of fact, it would have been kind of weird based on the review of the strategy. I think for the very short term, we're going to be in some range trading between 117, 118, 118 plus. But I think the big story here that the market may be mispricing is the rotation of growth from US to Europe. And the reason I'm saying this is because we still have more restrictions in place in Europe compared to the US. And as this COVID situation improves, because we believe it will improve, and we think the UK is a prime example for that, you're going to have the alleviation of these restrictions in Europe. And that is why right now, if you look at the ratio between the Eurozone PMI and the US ISM, is actually rising quite sharply. And we think this is going to be a tailwind for the currency in the second half of the year.
Do you understand the reaction function of the ECB? I get the data. That's the call on the data. I need to understand how you think the ECB responds to it. Do you understand the reaction function of the ECB?
I pretend I do. Let me put it this way. And I think everyone else in the market is of the same reasoning. Look, there isn't really a lot to say about the ECB right now. The reality of the matter is that the ECB is maxed out in terms of what it has done and what it can actually do. Yes, it was a dovish one. It was a dovish press conference. It was a dovish statement, but it doesn't really change anything. And at the end of the day, let's not forget, they've been doing this for the past 6 years or so. And it hasn't really changed that much as far as the inflation is concerned, although we don't know the counterfactual. So it would be a bit naive to believe that it is going to change substantially what's coming in the future. The ECB cannot create inflation.
Coming back here to the U.S., the massive call of 2021 was dollar weakness. Have you seen the dollar weakness behind us for the year?
Well, what has actually changed, I think, and that was something from March onwards. We went through 2 different narratives in the market. The first one was the surprise from the Fed. And the fact that we started having in the pricing in of more hikes in 2023. And the second one was the change in the narrative from inflation scare to growth scare. I'm still in the camp of some moderate, not outsized, some moderate dollar weakness. Again, that's largely call on the fact that we're still in a growing activity environment. That historically, the stylized fact is the dollar depreciates in periods of growth, even if yields go higher from here. But of course, if we do get into some tail risk analysis and they manifest, be it COVID or something else, then we're going to see some ongoing dollar strength.
Vasilios Giannakis from Bank Lombard Odier, the global head of FX strategy, diplomatic about the European Central Bank and that news conference that took place yesterday. Good to see you, Vasilios. Good to catch up. Thank you, sir. Tom, you and I talked about the division between, say, a President Bullard and a Governor Brainerd. Let's talk about the division at the ECB. We reflected on this a little bit earlier this morning. A story out by Reuters on that division and some of the dissent that Christine Lagarde, the ECB president, had to deal with. And here's the quote. A third policymaker who also voiced significant objections had to leave the meeting early and was not present at the final tally. This according to a source of theirs. That just gives you an idea of the level, the degree of dissent within the ECB right now, Tom.
I don't, I'm a bit of a student of Fed history, John, but I can't recall from McChesney Martin, say 1951, a gap of style that we've seen from Draghi to Lagarde. without any aspersion against either of them. But what a change of messaging have we seen with Christine Lagarde?
I think most people in this market miss the communication of President Draghi. Tom, that's for sure. Bottom line.
Yeah,
and that was a high bar anyway. Let's be clear about that. Could the bar be any higher for the handoff? I think the bar was pretty high for Chairman Powell from Chair Yellen. And Chairman Powell, let's be clear, at the beginning of that tenure, Tom,
was rocky.
That was not pretty.
Absolutely.
At all.
It was not pretty.
I mean, the man that we heard from at the Economic Club in New York at the back end of 2018 is just a different person compared to the one we hear from at the moment.
John, I'm going to do a GDP analysis. I'm like, where's the boom in Europe? It's there, but no, it's not.
Yeah, Bank of America asking that question this morning too, Tom. The S&P up 18, advancing 0.4%. Yields higher by a basis point or two to 129.64. Another beautiful morning in New York City. Good morning to you all worldwide. This is Bloomberg.
With the First Word News, I'm Laura Wright. Talks between the European Union and the US on vaccine passports are making little progress. Bloomberg's learned that's because there's no federal certification program in America. The EU launched its COVID pass at the beginning of the month. The bloc is at an advanced stage of talks on the vaccine passport with the UK. Colony Capital founder Tom Barrack is back in federal court in Los Angeles today. The Trump ally will learn whether he will be released on bail after being charged with illegally lobbying for the United Arab Emirates. Prosecutors say Barrack is a flight risk. His lawyer says he's not guilty. JP Morgan is planning to more than double the number of advisors in its traditional broker business. The bank will expand in wealth management by hiring more than 500 advisors in the coming years. JP Morgan also wants to bring the unit closer to wealth managers who work in retail branches. Wall Street banks have been bulking up the businesses that cater to the affluent. Summer vacations in August may be a travel nightmare in the US. Two major airlines, Southwest and American, cancelled about 3% of their flights the first 6 days of July, while more than 33% were delayed. That's much higher than pre-pandemic levels. The blame's going to capacity constraints, labour shortages and unprecedented weather conditions. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
I definitely think that business travel will continue to recover. We were down about 69% with the business travel component in the month of June. We're expecting that will continue to recover to be down maybe 50% by September and then continue improving after that.
The outlook for these guys is brighter. Things are going to get better. That's the message from Gary Kelly, a taste from the airlines in America, the Southwest Airlines CEO there. From New York City this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro, together this morning with Taylor Riggs. Lisa back with us on Monday. Here's your equity market on the S&P 500, advancing again, three-day winning streak into Friday, up 18 this morning. We advanced 0.4%. Yields are higher, approaching 130, just south of that level at 129.47. Yields are higher by a basis point or two. Little conversation earlier about the euro. Do you understand the reaction function of the ECB? I'll leave that one open for you to think about. Euro dollar 117.62, down almost, Tom, 0.1%. Just fascinating to hear from the C-suite of the airlines. I've got no idea what the trajectory for policy from this administration at the federal level, at the state level, will be to deal with this surge in cases. I know everyone's got their view on what it should be. I've got no idea on what it will be, and what that will mean for these airlines, for mobility of consumers, for individuals, and ultimately what happens to international travel. We were told several days we'd find out. Tom, it's been more than a week.
Southwest Air, it's got to be the official airline of Love Island. Love is up 115% off the bottom. John up 160% at one point. And, you know, they've survived. I mean, that's really what we got to say about the group.
And the benefit there, Tom, is it's a domestic story. For the other players, the likes of United, Delta, American, that are hoping that corridor between London and New York gets going in a bigger way again, they've got to wait.
We will see. Dave Wilson with us now in the equity market. We could have a 4-hour conversation this morning about NASDAQ 115,000. We're not quite there right now. And you're looking at the shifts that have been made as we go into an end of summer view.
Yeah, we're talking about the U.S. versus the rest of the world. Now, there are some people who will tell you that U.S. stocks peaked in February, depending on what indicators you pay attention to. But if you look at the U.S. in a global context, you get a very different story. What we're looking at here is the S&P 500 relative to something called the S&P Global ex-U.S. Broad Market Index. So in other words, developed and emerging markets outside the U.S. And you saw that ratio between the two indicators drop about 10.5% from a high in September to a low in February. And since then, it's made back the entire decline. It set a record 2 weeks ago. It set another record on Tuesday.
Full breadth into that. All the gloom crew this morning is talking about a lack of breadth out there. Is this comeback in America really the comeback of Amazon, Apple, and the rest of the high flyers?
Well, you can argue that to some extent. Clearly, they dominate the S&P 500, and that's the benchmark in terms of this particular comparison. You know, that said, I mean, you know, U.S. stocks across the board are kind of expensive at this point, whether you look specifically at the S&P 500 or a broader picture of the market. There was a chart that Bloomberg Opinion's John Authors had out earlier this week looking at CAPE ratio, so cyclically adjusted price earnings, 10 years worth of results. And the U.S. came up as the most expensive among about 36 markets around the world. So clearly, people's willingness to pay up for U.S. stocks plays into this, too.
Taylor Riggs, I got like 47 people on a Friday morning telling me to go to cash.
Your triple leverage cash, right? Dave, let's not go to cash. Come with us on over to China, because you want to talk about what's trading at a discount. It's China. What are you hearing that is EM ex China, given the regulatory overhang of that country?
Trading at a discount, that's one way to put it, Taylor. Another way to put it is the government is really kind of roiling the markets. I mean, when you look at what's going on with DD Global, down below $10, a company that was sold last month in the U.S. at $14 for American depository receipt. You have that data security investigation going on. And the latest wrinkle, one that's been coming up for some time, people familiar with the matter saying that China's going to clamp down hard on online tutors. So you're seeing companies like New Oriental Education, TAL Education, Gaotu Tech Edu down like 50% or more in today's trading, and that's on top of losses that we've seen the last few months. So clearly, China is kind of its own market at this point, and it's one that's really being heavily influenced by government intervention.
David Wilson, thank you so much. Greatly appreciated this morning. John Ferro, I'm fired up about next week on earnings. I've been calling this for months that earnings are going to be there. Corporations will adjust and adapt. And again, John, I'm not so much looking at earnings and the headlines and that. I really want to know what the view forward is.
Apple, Microsoft, this coming Tuesday. The view forward on what, Tom? On the numbers or how they want to approach this surge in cases? That'll be interesting. Apple really led the way on that, Tom, around the pandemic. And we've already had some reporting from our team over the last week that they're delaying the return to office. And I wonder how much clarity we get from Mr. Cook over there at Apple. Out of Cupertino.
And also their unique relationship with China. Mark Gurman has been world-class on that for us. And they've got the new products come out and all that. But what do they do with China, both as a manufacturer, the floods part of that debate, and also what do they do with China as a consumer of their products?
So to strip out some supply chain risk, that's the conversation that's been going on for a long time. But I think what you touch on, Tom, is actually quite critical. Many investors want exposure to China over a long time horizon. The challenge now is you've got to do a heck of a lot more homework than you used to get exposure to that, given what's happened with DD over the last couple of weeks. And I'd go further. If you bring up that board again that Dave Wilson was working through, the year-to-date gains, I've been looking at the same thing. The Nikkei, what have you done for me lately? Not much. We're up 0.4%. Take a look at EM, the MSCI EM index. Tom, that has done pretty much nothing either. It's up 2% year to date. This was the trade that was meant to deliver this year. Ex-US, synchronized global growth, and it's just turned out to be far more complex than that. Ex-Europe. Europe's participated. Everything else, much less so.
John, I just did an eyeball on big tech ex-Tesla in the S&P 500, and it used to be 19-20%. It's now 22-ish%. What do we do when 1/4 of the S&P 500 is 6 stocks?
Yeah, well, I think we've had the conversation now for the last several years, haven't we?
But it's this. It's
what's that?
On radio,
Can you explain what that is?
It's just creeping up.
What is that?
It's creeping up.
I know, but what's this? What is it?
It's a radio signal I use.
Oh, okay. You mean it's getting higher?
It's getting higher.
You mean the stock market's getting higher, or the weighting's
it's very
getting higher?
lifty.
Should we work this out off air?
No, we don't need to work it
It might be a little bit more beneficial to our audience if we did that off air.
It's like I'm landing an airplane, you know?
Thank you, Tom. That's helpful. Let's work through the price action this morning on the S&P 500, three-day winning streak. No idea what's going on into Friday. Your equity market on the S&P 500 advancing almost 20 points. We're up by 4.5%. Just a range on a 10-year. I know I've been going on about it a lot. You might be bored of hearing it. But I just think it's amazing, Taylor, just to see us down at 112.60 on Tuesday and back out through 130 without much of a catalyst.
And I hate to say it, it's half technicals. I keep hearing it. Half of it's shorts, half of it's some of the positioning coming in. The other half, as we've heard from some of the more cautious analysts, is a little bit fundamental. How much of that was indeed the growth scare, John, on Monday?
It's giving life to a fundamental story. It's always the way, isn't it? You get the price move and then you get the narrative afterwards. And that's always the danger with something like this.
Hey, you've a Swissy 10-year negative 40 basis points. So 130 doesn't look so bad, right?
It doesn't. It looks okay, doesn't it?
Very philosophical on this Friday.
We're just working through things slowly, Tom, teeing up the weekend. Just get in there.
Your weekend
I know
is
that
to
you're
watch
distracted watching Ted Lasso already.
Got that right.
What was the first episode like?
First, not this year. Last year's first episode was fabulous.
Okay.
You'll know stuff, John, we don't even know.
I'll do that before
There'll
Real
be
Yield.
jokes
How's
in
that?
there.
I'll watch an episode.
I don't get it.
From New York, this is Bloomberg.
You have a natural just sort of slowing in sequential growth. You're not going to keep growing at 10%.
We have an economy that's going to continue to grow, but the largest gains may be behind us.
Almost everything has told us here that we're in a regime shift. We're going to now see growth decelerate and inflation decelerate.
Inflation has already risen significantly higher than the Fed had earlier predicted it would.
There might be a surprise out of the Fed. It seems like there are some very hawkish members.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene. A simulcast, Bloomberg Radio, Bloomberg Television. A Friday to reset, dare I say, John Ferro, into August. And it is a bull market that will not end.
Another lift this morning, Tom, up 0.4%. And I think we have to look way past August and into next year. We're at an important point, a pivotal point, if you believe the CDC, for the pandemic. I would go further for policy. I would say for the outlook as well. We won't get the answers to these questions, Tom. We won't begin to get the answers to these questions on the outlook until September, October time. Everybody comes on this program and talks about it for good reason. September, critical for the additional unemployment insurance to end, for the return to school to develop. And as you point out, Tom, there's some risks around that now.
Yeah.
And September, October will produce the data that gives people either the confidence to look ahead to a brighter 22 or perhaps the reason to trim their forecasts.
An exceptionally strong hour for you of Bloomberg Surveillance on radio, on television. Peter Hotez will join us later in the hour. Before that, Edward Hyman will join us with his view, the micro data that Ed Hyman is world acclaimed for. And we have Sam Stovall with us with CFRA on the equity boom. In a moment. The color to me, John, is what did not happen this week, and that is the 10-year yield did absolutely nothing if I look back 1 week.
From Friday to Friday, yes, but a lot in between. I've talked about that range from 112.60 at the lows on Tuesday, the highs yesterday afternoon at 131, right now 129.81. That speaks to exactly what you and I were just talking about, Tom.
Right.
The lack of consensus, the lack of a narrative, a story that we can all agree on about the future, or most people can agree on. I think that's broken down a fair bit over the last several months.
Lisa Abramowitz scheduled return for Monday with the travel constraints that I'm seeing within our First Word News. That's up in the air. Taylor Riggs with us this morning. Taylor, your observation on the earnings dynamic that you tear apart every afternoon on the close.
Rohit Kulkarni, MKM Partners, it's a beat and a raise kind of day, at least for some of the big tech stocks. And Tom, we talked about this earlier, just the clarity that we're continuing to get from CEOs. You saw it not only yesterday morning, yesterday night, further perhaps maybe this morning, of the strong forward guidance that we continue to get into this year. I would dare to say it, peak margins may not be behind us.
John, what's fascinating to me looking at the futures, let's do the data now, John. Futures up 20, Dow futures up 188. I've got a near 15,000 print on NASDAQ 100, and the VIX giving me a 16.98 print. John, that's a bull market.
It is. And this equity market is close to an all-time high again. It's at a record high on the Nasdaq. At the moment, we're up 20 on the S&P, advancing 4.5%. Talked a lot about the bond market, 10 years south of 130, pushing higher by a couple of basis points to 129.81. Take a look at credit. Tom, and high yield credit and the issuance that's come through this market. There's a difference between choppy waters and a threat to this bull market. We're talking about choppy waters. We're always thinking about the shark closest to the boat, and often sometimes the storm clouds on the horizon. Let's talk about how strong the boat is right now. Carnival came to market this week and issued 7-year debt with a 4% coupon. Back in the spring of 2020, that was 11.5%. That is a massive turnaround.
Yeah.
And that's a company facing some real risk through the summer and beyond, Tom. I'd go one step further. Think about what that money's being used for. Use of cash. What are they raising the money for? To pay down the debt that they raised at 11.5% last spring. So these creditors, these companies coming to market, they're issuing debt, Tom, at much lower interest rates. They're using it to strengthen the balance sheet as well. And I think that's really important. So when we talk about these risks around this market at the moment, we're talking about choppy waters and not a threat to the bull market. It spreads wider this week. We had a crack earlier this week. We're still in at around 300 basis points. They're pretty good levels for people to come to this market, borrow money, and as long as that credit market is functioning, I think you can still have some confidence about risk assets. That would be the view of a lot of people.
And then there's the debt constraint, the screen on the Bloomberg, folks, WACC, weighted average cost of capital. WACC is great. John, Microsoft is burdened with debt. How about 4.4%?
They're doing okay, aren't they? Again, of almost 30% year to date on the stock. How many times have we underestimated the ability of that company over the last decade? And they just keep delivering, Tom.
That gives us a good perspective. Samuel Stovall joins us this morning with CFRA, their chief investment strategist. But far more, it is the decades of work across the Stovall family about corporations adapting. Sam Stovall, how are corporate officers adapting to the 2020, 2021 cards they've been dealt?
Well, good morning, Tom, and thank you for that nice intro. Certainly, they have to adapt to what is confronting them right now, whether it's the interest rate scenario, the prospects for inflation, the possibility that the Fed will be tapering, as well as raising interest rates. But probably the biggest challenge right now is what we're reading about in terms of supply disruptions, in terms of cost of goods going up. In particular, consumer staples areas are seeing a tremendous upward push in terms of the cost of goods, and that the real quandary is whether they're going to be able to pass these higher prices on to consumers, either in the form of just higher prices or possibly reduced volumes. But that is something that they're going to have to wrestle with for quite some time.
Sam, we can pick a name, any name, and use that as a data point and example. Chipotle came out earlier this week, and they're pretty confident about the consumer price tolerance on the other side of these price hikes. That's just one name, though. Taylor's been pointing out all week when she's joined us to focus on margins. So let's do that right now more broadly. Do you have the confidence that the price tolerance is there across a range of industries?
I'm not sure that you have a price tolerance across a range. Certainly, a lot of consumers are very forgiving now because they're finally being offered parole from cabin fever. And so they are probably going to be willing to pay a little bit more just to satisfy that need to get out. But I do think that the question is, if this is something that's going to be with us for another year, and that we're really only going to see the year-on-year change in inflation come back below 3% in the second quarter of 2022, that might be a little bit too long in which consumers are going to be willing to be paying higher prices. So I think we could see some pushback.
Sam, dare I ask about who is buying these dips? We had a report out from Vanda Research earlier on Monday saying a 2% pullback leads to a huge rebound Tuesday and Wednesday because you've massive savings rate that's been piling up, and it is that retail investor that's buying this market. Do you agree?
Well, it seems like that is the factor that's been pushing things higher. When your initial question is who was buying on Monday, it wasn't me. My feeling was, I guess I'm getting tired of hearing myself cry wolf, because my expectation was that we are going to challenge the 50-day moving average and then most likely challenge the 200-day moving average on the S&P, because we have gone more than 300 days since the last decline of 5% or more versus the average of 178 days going back to World War II, and many other factors in terms of waning participation, et cetera.
Sam Stovall, how do you respond to a serious question of when the Fed finally reins it in, how equities respond? How do you answer that question?
Well, I think the way you answer it is by saying that with enough transparency, I don't think it's going to have that big of an impact on equity prices. Already, we've been hearing a lot of Fed members talk about tapering that's going to take place probably by the end of this year, not beginning of next year, that Fed rate increases will occur by the end of next year, not the beginning of 2023. So in a sense, they've been issuing or letting aloft several trial balloons, in my opinion, that are going to be preparing the markets for a more rapid change in monetary policy, and that they are going to go through the tapering process nearly completely before they even consider raising rates. So transparency, I think, will be the key.
Sam, we've had the taper test before. Just quickly, is that an environment where risk assets can still do well through tapering? Do I need to worry more about when we start thinking about reducing the balance sheet?
I think that we can do fairly well. I mean, the last time we really saw something like that, we also had the downgrading of the U.S. debt, which really was the big surprise in August of 2011. I don't think we're going to be seeing something, a repeat of that this time around. So I would tend to say is don't throw us any curves, and the market will be able to set itself up properly to continue to work forward.
Sam Stovall, a CFRA. Sam, it's good to catch up. Stay well.
Sam, thank you.
It's good to see you. Good to hear from you. Thank you, sir. This equity market performance continues, up 20 on the S&P 500 this Friday morning, approaching the opening bell, 1 hour and 20 minutes away. We're up by 0.45%. That Fed decision, Tom, July 28th, coming up next week.
Yeah, we haven't said enough about that. That's going to be an important landmark next week, surrounded by the earnings as well. John, the other story to go to Sam Stovall is the durability of this great bull market, and it reminds me of the character Paul Robinson in The Neighbors. I mean, you look at what Paul Robinson has done across a zillion years of that Australian show, and it just keeps going and going.
That is a great show. Why have you brought that up, Tom?
The durability
like
of the bull market.
The durability of Neighbours.
I don't get it. It's
started
like
in the
Little
mid-'80s.
Britain.
Fantastic program. Do you know Kylie Minogue?
Yeah, Kylie was on it years ago,
That's how Kylie made
right?
her start.
Yeah.
Do you know Margot Robbie?
Yeah.
That's how Margot Robbie made her start in acting. I can think of another. Do you want to keep going through this?
No, I don't want to go through it because I know you're...
I'm told Hemsworth was in it too.
Well, but the knowledge base you have on this, I mean, it's like the old Love Island. I mean,
Yeah.
it just goes and goes.
I'll catch up on that through the
But
weekend,
the
Tom,
length
just
of
for
this
you.
bull market, John,
It's as
is
durable as an
extraordinary.
Australian
Who guessed,
soap.
John, who would have
Thank
guessed
you.
this bull market where it is?
I'm with you, Tom. A lot of doubters out there. What did you start calling it a long time ago? The most hated bull market ever?
It still is.
Still is.
No, this weekend. You mark my words, Friday by 5 p.m. this afternoon, there'll be 7 doom and gloom articles out there.
Up 20 on the S&P, advancing
I'm
again.
comfortable in
Up
cash.
4.5% I can tell. You sound really happy this morning.
I
From
wish
New
they'd
York
make
City,
a longer episode. of
alongside
me.
Tom Keene. I'm Jonathan Ferro. Futures positive in a beautiful New York City. Good morning to you all. Just ahead of the long weekend, if you can get out of work early this morning. Hopefully you can. I'm going to try and do that, Tom. You're going to anchor real yield a little bit later this afternoon. They told you that? You've just found out. This is Bloomberg.
With the First Word News, I'm Laura Wright. A bipartisan group of U.S. senators is closing in on a $579 billion infrastructure deal. They agreed to pay for it in part by delaying a costly Trump-era Medicare regulation. Details won't be announced until at least Monday, and any deal could face opposition from Democrats in both houses of Congress. A new survey says the Fed will start scaling back asset purchases next year, and policymakers are likely to put an emphasis on mortgage-backed securities. Economists surveyed by Bloomberg see the Fed raising interest rates at a quicker pace through 2024 than previously thought. Most also expect Chairman Jerome Powell will be nominated for a second term. Some promising news about Pfizer's coronavirus vaccine. Israel's health ministry says it provided a strong shield against hospitalization and more severe diseases in cases caused by the Delta variant. But the vaccine was only 39% effective in preventing infections. The data is likely to fuel debate over whether booster shots should be given to people who've already been vaccinated. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
I think as you look at earnings going forward for companies, you have to take into account input costs going up. It's a clear area where there are some challenges today, and our instinct is this will persist for some time.
Can they pass on those higher costs? The big debate in the C-suite for corporate America. John Gray there, Blackstone president and COO. From New York City this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro, together with Taylor Riggs. Lisa back with us this coming Monday. Going into the weekend with your equity market elevated on the S&P 500, a three-day winning streak that could turn into four, up 20 on the S&P. We advanced by 0.46%, a lift on a 10-year yield by a couple of basis points to 129.64. The euro unchanged at 117.70. Outside of that in a commodity market, almost $72 a barrel on crude, just south of that level at 71 and around 75. We're negative, Tom, 0.2%. On
a Friday, John, we begin our coverage of technology. We will do that into next week as well. And we start strong with Anand Srinivasan. He's with Bloomberg Intelligence, a senior analyst, years at Lazard, at Merrill, and what you need to know is truly one of the most careful thinkers about this juggernaut that's affected all of us in society. Anand, thank you so much for setting up next week for us. How big can these things get? Right now, let's say the top 4, 5, 6 companies are 19, 20% of S&P 500. Can you envision them out to 30% of the Standard & Poor's 500 index?
So that's a great question, Tom. It kind of depends on what the rest of the S&P 500 does too. But I can safely say that there's some growth ahead for companies like Apple. Demand doesn't seem to be sort of weakening at all. If anything, supply constraints are having them leave some revenue on the table when they ship product because they're not able to get it all. But we're expecting a great quarter and a great fiscal year for Apple, and we think that demand sticks around for a little bit longer.
How do you respond in casual conversation, and I don't want to get into buy, hold, sell here, Anand, to someone who says, for example, Amazon, they've got to break up the cloud and the cardboard box. How does a pro like you respond to that?
Well, I lean on my antitrust colleagues, Jennifer Rees specifically, and one of the things that she says is you can have a monopoly as long as it's organically built, right? So when you stifle competition and you take away sort of opportunities with other companies to expand, that's when you get into a sticky wicket from a regulatory perspective. But you have to be able to. We've had smaller companies potentially compete with Amazon. They just haven't had staying power. And able to compete as broadly and as diversely with Amazon. So on that aspect, there's more to the story than just a simple breakup. It's not that easy.
Well, let's work through it. Let's say it was easy and they could do it. Would that be bad for these companies, Anand? Could that actually work out for them? There's merit on potentially separating out the cloud business from the retail business. Again, Amazon is covered by my retail and software colleagues, but there is merit for cloud potential expansion, right? So one business is really high margin, really fast growing. The other one is large revenue, but potentially much, much lower margin. So there is merit to the argument that you could potentially separate it. But again, Amazon's a bowl of wax that's left to my retail and software colleagues.
And on back to Apple, there's a goal of cash neutrality, and I'm wondering how you get there when you're sitting on $200 billion of cash and only $120 billion of debt. And so net cash, you're still at almost $100 billion, and your free cash flow is $100 billion a year. How do you get to cash neutrality?
You don't, is the short answer, particularly if you take into account their M&A strategy, which is really small tuck-ins, Taylor. So cash neutrality is a nice goal in theory, but we don't see them getting there anytime soon without large acquisitions. And there's merit to the case that if you buy something like an NFL Sunday ticket, large media content purchase or a couple of studios in the media space, you can seriously add clout to your services business, which they need, to be quite honest, on the media side. So you can expand in that area, you can reduce cash, and you can set up the business for the next 5 years. But they haven't done that thus far. And, even projects like, their silicon expansion, potentially Apple TV, et cetera, those projects don't cost that much from an R&D perspective. So cash neutrality, not going to happen anytime soon.
What I hear, Anand, always from you, and I think of the great Mary Meeker as well, is a migration to the cell phone. And all these companies, the common theme is our changed behavior. We've got Ted Lasso rolling out today for Apple Plus TV. You guys keep talking about 5G. Does Ted Lasso care about 5G?
That's a good question. But, think about this, right? So more content, more speed of the platform, a strong product with which to do it. What does that make the consumer? That makes the consumer addicted to the Apple ecosystem, and that makes the consumer buy more and stay with Apple longer. And that's the sort of the cycle that Apple wants you to be on. Buy more product, consume more product, stay on the Apple ecosystem, repeat.
Only
right?
Tom could ask
and
that question.
And that is an incredibly profitable franchise.
And it'd be called a good question. Tom, I wouldn't have got away with that. You got away with that. Let's finish up here.
You
Intel,
gotta believe, John.
Texas
You
Instruments,
gotta believe.
and just quickly, they're the two names that you do actually follow really closely. So let's finish there quickly. What have you learned this week?
So, the TI and Intel stories, we think that TI was incredibly conservative in its guidance. We are maintaining our scenario numbers much higher than management guidance. We think that that there's more room for sales expansion. On the Intel side, the PC numbers and the corporate IT server numbers were good. But, I'm holding out for cloud growth to come back, number one. Number two is, show me the long-term roadmap in technology and how you're going to compete against AMD and TSMC. The foundry strategy has a lot of people's heads being scratched, and we're not there yet. So in the meanwhile, make your own product better and more competitive versus AMD. So we're still holding out on that, still sort of show me story on Intel.
Anand, great to catch up with you, as always. Super sharp, super smart. Intel this morning down by 2.4% in the pre-market. That was Anand Srinivasan, Bloomberg Intelligence Senior Analyst. And here's the price action going into the opening bell. A little more than 60 minutes away, 65 minutes away in the equity market. 3 days of gains, a week of gains on the cards too. Could make it a fourth day of gains, Tom. On the S&P, we advanced 21 points, up 0.5%. Euro dollar unchanged at 117.71. Your bond market as follows. A lift in yields again by a couple of basis points to 129.81, Tom. Just approaching 130 again.
I did not buy the dip, John.
You didn't? Quite clearly.
I was looking for an entry point, and it was like Tuesday for a 10-minute.
I'd love to join a conversation one day with your advisor. Just at some point.
Well, Vet Bill was sleeping, and I
would love to hear what that sounds like.
Surveillance nap.
From a beautiful New York City this morning. Ed Hyman up next. This is Bloomberg. Live from New York City for our audience worldwide on TV and radio. Good morning to you all. Alongside Tom Keene this morning, I'm Jonathan Ferro, together with Taylor Riggs. Lisa Abramowitz will be back with us this coming Monday. Here's the price action for all of the doom and gloom around the bond market conversation. Your equity market is about to post a week of gains of north of 0.9%. Going into Friday, there's another lift, up 0.5% this morning on futures. We advanced 21 points. Huge weekly range on a 10-year. 129.47 is where we are at the moment. Yields higher by a basis point or two, Tom, just south of 130.
I would say a velocity of the equity markets in the last 90 minutes. We've seen a further lift up here. The VIX through 16.92. A 15 print on the VIX later today would be extraordinary. He is extraordinary. Many would say that Edward Hyman invented market economics with honor and grace to Alan Greenspan as well. Evercore ISI chairman, and we're thrilled that Ed Hyman could brief us here into August, into Q3, and into Q4 of this tumultuous 2021. Ed, I want to cut to the chase. You've seen this out of your engineering at MIT, an era of pricing power, it can't happen. Another era of pricing power, it can't happen. And this time around, you say there is pricing power and corporations can adapt to the new inflation. How do they do it?
So when we survey retailers in particular, they tell us that pricing power is the most ever. We also survey manufacturing companies. They say the same thing. And so costs are up, but independent of that, labor costs are up also. But independent of that, companies are able to pass it along. Because the economy is good, people are getting pay increases. But that also is important because it allows earnings to go up. And earnings are, in the second quarter, they were explosive. But I guess more important, they'll be strong in the third quarter as well.
What do you see for Q4? I mean, the idea here of inventing market economics into market analysis, many would say you did that. Chart, paragraph, chart, paragraph. What do the charts say now about the fourth quarter?
So in terms of economic growth, we have it slowing down to about 6% from roughly 10% in the second and third quarters. But because I'm really focused on the stock market, I think earnings will increase again. We have earnings in the second quarter at $2.20, which is probably $20 ahead of the consensus, and then maybe $2.30 and maybe $2.40 in the third and fourth quarters, and that puts the PE, something like 19 times, with bond yields, below 2%, and the Fed balance sheet increasing $120 billion every single month.
Ed, you mentioned higher prices. You alluded to what you thought, but I just want to get you to emphasize it just a little bit more. Higher prices laying the foundation for higher prices, that virtuous cycle that seems to be taking place at the moment. Is that a virtuous cycle you think overwhelms the Federal Reserve, or is this the right kind of price growth?
Well, I think inflation is going to be more than expected. We do a lot of work on rents, and they are surging. And that's 40% of the core CPI, 20% of the core PCE. And so rents are going to be running around 6%. You can do the math on what that does. And then wages will be going up. And like we discussed a second ago, pricing power is going up. So inflation is likely to run ahead of expectations. But I think it'll settle out at around 3%. In, say, 2023, 2024. So it won't get out of hand, but it's be higher than it has been in the past.
Ed, how does that shape your views on what the Federal Reserve is going to do in that kind of environment? 3%, clearly below where we are right now, but that higher rate of change, if you think that's going to stick, 23, 24, I just wonder how that shapes your views on monetary policy.
Well, I hate to state the obvious with a thrill of discovery, but they're going to move. And they've already indicated they're going to move, so they'll start to taper. It'll take about a year to get down to zero, and then they'll start to raise rates. And neither of those are tightening; they're just less stimulative. And then if they keep raising rates, which will be down the road quite a bit, they'll finally get to a tightening position. So I think the Fed right now is probably behind what I see. But they're moving, and so they'll keep moving. And whether they start to taper in December or January, which is sort of the discussion at the moment, doesn't make a big difference, I think, in the big picture.
Do you see a taper tantrum, or has that already happened?
Bernanke gave us a good way to avoid it. He showed you what can happen, and so they've been very careful in trying to avoid a taper tantrum, and I think they've been largely successful. Now everybody is on the same page that they'll, discuss it in upcoming meetings. Lead story in the Journal today, and then probably by January they'll start to cut the balance sheet expansion by 10 billion. So it'll be 120, 110, 100, 90, 80, 70, 60. Then you'll get to zero in 12 months.
Yeah. Ed, the hallmark of what you invented is your granularity. Folks, we used to wait with bated breath. Ed would sleep in, and we'd be lucky if we got the report by 10 a.m., and there'd be this big, ugly black marker on it where Hyman would say, shut up and listen to this. This is C.J. Lawrence, and then on to ISI, and now Evercore ISI. How does your granularity, your study of American business, respond to business people that say they can't find workers? Do you just say to yourself, Ed, raise the damn wage? I mean, how do you respond to that?
Well, pretty much. We'll see if there's an increase in wages, increase in workers when the enhanced benefits roll off in September. But I agree with the way you implied, and that's what I see is happening. Companies will simply raise pay, and from what I can tell, at the $15, $20 an hour wage, if you do $2 or $3, you get a significant change in the number of people applying. That seems to be enough, and so I think that you're going to see, a pretty big pop in wages. Could be transitory as well, but you'll see a pretty big pop in wages.
Right.
But it's also moving up the chain. You saw where BlackRock is giving an 8% across the board pay increase, and for bankers they're up to $100,000 an hour, I guess. And so it's not just $15 an hour workers.
And Hyman, should Jerome Powell continue in his services to the Federal Reserve System in America?
We'll find out. It's not a done deal, in my opinion. But I'm sure Biden is considering the options and considering whether or not he needs to work on having a broader footprint.
I mean, John, I could see it now, John.
I don't think it makes a difference if he's replaced. The person that replaces him will probably be, a little bit more dovish than he is, and I think he's done. If anything, he's too dovish, but it won't be a tightening.
I think, John, what we got to come to the conclusion is Chairman Hyman would look awfully good at the Eccles Bowl.
Oh, there we go. I don't think Ed wants to respond to that.
John, don't listen to that guy.
I'm not going to go there, Ed. Don't worry. Beyond this, though, for you, for the chairman, for the FOMC, looking down to Washington at the moment, I think is so difficult for a lot of people. Just getting the direction right earlier this year was somewhat straightforward. You knew that Washington, D.C. would be a tailwind for your GDP forecasts. Everyone was revising GDP revisions higher. It was a positive growth shock. Ed, can you look down to D.C. now and characterize things for us, just on the fiscal side? The range of outcomes and how wide they are for you as you try and generate a decent outlook with some confidence.
So first, let's not leave the monetary part behind, because this is still, I think, a huge tailwind, and monetary policy leads by 1 and 2 years. But on the fiscal side, my team in Washington comes to about $2 trillion when the dust all settles, and it's not the $3.5 trillion that they're looking for, but it's not $1 trillion either. And so I think you'll get, more stimulus. Now that's over, say, a decade. So it's a couple $100 billion a year. I say a couple $100 billion.
The world's changed, Ed.
Tailwind.
The world's changed. There was a time when a couple of $100 billion was something big, and now anything under $1 trillion, you're a fiscal hawk. Chairman Ed Hyman, it's good to catch up. Of Evercore, not the Federal Reserve. Ed, it's good to see you. Thank you so much for joining us. In your equity market right now, there is a lift. There's a conversation we need to have about the outlook. We're going to continue the conversation we started there with Ed Hyman, with Mohammed Al-Erin of Queen's College, Cambridge. The president joins us a little bit later, Tom, in about 20 minutes' time on Bloomberg TV.
It's really important there, because I think from the granularity of Ed Hyman, I got some enthusiasm, and I think Dr. Al-Erin is a little more cautious there about summing in the greater system into into what it means for markets.
They're both on the same page about inflation risk. They're on similar pages around whether the Fed is or isn't behind the curve.
What will that inflation do?
I'm trying to understand the degree to which Mohammed now believes that this Federal Reserve will be overwhelmed by the inflation outcomes that he thinks we're going to see. And I'm also trying to establish the degree of confidence you can have about the economic outcomes beyond September, because I think at the moment that's really, really difficult.
To me, the key there is the phrase beyond September. We need to learn that from corporations in these earnings calls.
From New York City this morning, good morning. Been great to be with you. Taylor Riggs, thank you very much for being with us. It's been a long week for you. More still to come from Taylor at the close a little bit later. Taylor Riggs, thank you.
I'm still here.
Lisa is back with us on Monday as well. With Tom Keene, Jonathan Ferro, Taylor Riggs, and with your equity market pushing higher from New York City, this is Bloomberg.
With the First Word News, I'm Laura Wright. Talks between the European Union and the US on vaccine passports are making little progress. Bloomberg's learned that's because there's no federal certification program in America. The EU launched its COVID pass at the beginning of the month. The bloc is at an advanced stage of talks on the vaccine passport with the UK. Colony Capital founder Tom Barrack is back in federal court in Los Angeles today. The Trump ally will learn whether he will be released on bail after being charged with illegally lobbying for the United Arab Emirates. Prosecutors say Barrack is a flight risk. His lawyer says he's not guilty. JP Morgan is planning to more than double the number of advisors in its traditional broker business. The bank will expand in wealth management by hiring more than 500 advisors in the coming years. JP Morgan also wants to bring the unit closer to wealth managers who work in retail branches. Wall Street banks have been bulking up the businesses that cater to the affluent. Intel says the worst of a semiconductor sales slump has passed, and CEO Pat Gelsinger is sounding bullish about the chipmaker's prospects for the rest of the year. Intel's most lucrative business, server processors, picked up in the second quarter from the first. Still, investors worry that the division's 9% decline in sales may signal a long road to recovery. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
You lose something from a connectedness by being so remote. And so, while it worked well for the time, we're committed to getting back into our offices, getting back into the restaurants.
The gentleman from Duke, Chris Kempczinski, he's with McDonald's, their CEO. Really interesting background, selling soap at Procter & Gamble years ago and a path to running, the best cheeseburgers on the planet. He's with David Rubenstein, peer-to-peer, August 4th. Look for that on Bloomberg Television. Taylor Riggs in for Lisa Abramowitz. And right now, our great honor to get some clarity on where we are in this pandemic. We do this with Peter Hotez, who's become nationally known, many media appearances, speaking in English, and also as a piñata for the anti-vaccination crew. We're thrilled that Dr. Hotez could join us. Yes, from Baylor College of Medicine, but far more, you need to know he is co-director of Parasites Without Borders, with an incredible focus on the children of this world. He's Texas Children's Hospital endowed chair in tropical pediatrics. Peter Hotez, you deal 24/7 in children. What is the risk to our children of the Delta variant?
Tom, I think what's happening is it's not that this virus is selectively targeting children. I think what's happening is this is so highly transmissible. It's twice as transmissible as the previous earliest lineages that we had. So pretty much anyone who's not been vaccinated or previously infected and recovered is getting swept up in this along with kids, and particularly in areas where they haven't vaccinated well, people forget that you're not getting vaccinated only to keep yourself out of the hospital, your loved ones, but also if enough people get vaccinated in the community, then it slows or halts transmission. So the kids who are not eligible to get vaccinated are protected. And that's what's happening in the Northeast. But unfortunately, it's not happening down here in the South where the vaccination rates are just so abysmal.
Peter, how sick do children get? Is that part of it? The unvaccinated would say it's one big so what. Is it a so what?
Yeah, and so what, the misinformation, the disinformation out there is, they quote death rates and they only point to older Americans or those with profound underlying disabilities that are those who get, not even disabilities, but comorbid conditions who lose their life. And the problem is we have a lot of young adults, adolescents, and even kids who are, one, getting sick, very sick, requiring hospitalization. Now we're starting to see pediatric intensive care units for adolescents and some of the younger kids start to fill up. And we don't know the full extent of long COVID, this more long-term condition which includes neurologic injury, and we don't know how long-lasting that is. So it's all hands on deck to try to keep the kids from getting infected.
Should schools be fully reopened?
Look, I think it really depends on where the transmission is. And by the way, whether I think they should be fully opened or not doesn't really matter. That ship has sailed, and pretty much in-person classes for a lot of the country. I think the key is trying to get the adults and adolescents fully vaccinated. But like if you look in Louisiana or Mississippi, 16% of the adolescents are vaccinated who are eligible, maybe 40% of the young adults. It's ridiculous. So that, and you have a lot of some of the red state governors refusing any mask mandates, and you have the Delta variant. I say, well, what could possibly go wrong, right? I mean, so I think we're asking for trouble the way we're managing this. We've got to jack up vaccination rates in the South if we're going to do well in the school year.
So let's talk about the mask mandates. I go home to the home state of California, and it's LA County that is mandating masks indoors and outdoors for fully vaccinated individuals. Should that be a requirement?
Yeah, I mean, certainly for indoors as Delta accelerates, and the reason, and certainly for unvaccinated individuals who are at high risk, but even the vaccinated ones, and it takes a little bit of time to explain, but we think what's happening based on some preliminary studies out of China and Guangdong province, that this virus is multiplying at much higher rates in the nose and mouth, 1,000 times more. So you're shedding a lot more virus. So even if you're vaccinated and you get asymptomatic infection, in the past with previous lineages, the vaccine was really good at not only stopping symptomatic illness, but even asymptomatic transmission. What's less clear now is with this Delta variant, certainly the first parameter is holding, that it keeps you from getting seriously ill or even symptomatic illness at very high rates, so that's great. But people who are vaccinated may still be shedding a fair bit of virus if they get asymptomatic infection, and that's the reason for remasking even if you're vaccinated. The CDC has not come out with that recommendation, but that's where possibly things could head.
Peter, 6 months ago, you had the courage to publish an article linking Soviet theory with American anti-science. You said anti-science kills. Elaborate on that now with 6 months more knowledge of this pandemic.
Well, we just have to look at the numbers, Tom, right? I mean, there's the reason why 600,000 or more Americans have lost their lives from COVID-19 is partly due to the SARS-2 coronavirus. But in my opinion, an equal measure was due to defiance over masks and social distancing, not defiance over vaccines. And it's all a consequence of a massive, what I call disinformation empire, which, we heard a little bit about it last week and this week from the White House around Facebook. But, I point out this is so much more than Facebook. This is, this anti-science aggression coming out of U.S. members of Congress, out of some of the conservative cable news networks. We're seeing it now. It's been well reported now. The Russian government is trying to destabilize our democracy through what's called weaponized health communication, using anti-science as a wedge issue. And then we have the non-governmental organizations, at least a dozen of them identified by the Center for Countering Digital Hate. It's amazing we have to have an organization called the Center for Countering Digital Hate that has some 60 million followers. So this is a well-oiled machine or empire. And I make the point is, look, the U.S. government puts a lot of effort into putting in infrastructure to combat global terrorism, to combat nuclear proliferation, to combat cyber attacks. But you know what? This anti-science thing is killing more Americans than all those others combined. And we need to recognize that. And so far, the Biden administration is just kind of skirting around the edges, throwing a few darts at Facebook. This won't do it.
We'll continue this conversation. Dr. Hotez, thank you so much for briefing us this morning with the Baylor College National School of Tropical Medicine, Peter Hotez. Taylor, I want to drive to the close this afternoon. It's Friday, so are there earnings out today or not?
We don't really get the earnings story, Tom, but I was going to say earlier that, Hyman, it's just incredible. We were speaking with the CEO of Whirlpool yesterday. They're raising prices across the board up to 12%. Consumers aren't even blinking.
Yeah.
It is unbelievable.
And the key thing there is the number 12%, folks. It's like the rent's up 6%. These are not the incremental price increases and the cuteness of how many tomatoes in the can that Jack Welch was talking about years ago. These are big moves.
So we won't have earnings, but we'll do inflation for you and real wages. How about that?
Okay. We note the McDonald's conversation. He runs like 50 miles a week. Taylor Riggs runs about 60 miles a week, and I don't.
Stop eating McDonald's,
Taylor Riggs,
Tom.
nice to join us today. Thank you so much. Futures up 18. Stay with us on Bloomberg Radio and Bloomberg Television. Good morning.